The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve Banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve Banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
So, good morning, everyone. It is with great pleasure that we welcome you to the 13th conference of the International Research Forum on Monetary Policy. I'm Matteo Iacoviello from the Federal Reserve Board and one of the organizers of the conference, alongside Ania Lipinska and Giovanni Liconò, also from the Federal Reserve, Barbara Rossi from Pompeo Fabra, Eleonora Granziera from Norges Bank, Peter Karadi, Bartosz Makowiak, and Oreste Tristani from the European Central Bank. We'd like to express a special welcome to our many participants and attendees that have come all the way here, as well as welcome those who are following us through live stream. I'd also like to extend a special thanks to Joe, Jessica, Isaac, Lindsay, Amanda, Catherine, Erin, and Joe, who've done a wonderful job in tackling the many logistical challenges of hosting a large conference. As you may know, the purpose of the International Research Forum on Monetary Policy is to promote the discussion of innovative research on macroeconomic issues with relevance for monetary policy. Indeed, many of the papers being presented today and tomorrow address themes that are of central importance to policymakers: drivers of inflation, business cycle co-movement, supply chains, the Phillips curve, identification and transmission of monetary policy shocks, price rigidities, inflation and profits, the role of banks in monetary policy transmission, and central bank independence and communication. In addition, today's program will feature a keynote lecture by Professor Mark Gertler of NYU, one of the intellectual leaders of the economics profession, and inspiration and guidance to many of us over the years. Tomorrow, the conference will also feature a panel discussion addressing challenges in the conquest of inflation in the post-pandemic world. We are honored that Bill English, Olivier Blanchard, James Bullard, and Silvana Terrero will participate. The International Research Forum on Monetary Policy has long benefited from its inception from the support of senior central bank officials. We are honored that ECB Executive Board member Isabel Schnabel will give a keynote speech tomorrow. Today, we will start the program with a keynote speech by the Vice Chair of the Federal Reserve Board, Philip Jefferson. We are pleased and appreciative that he has agreed to join us and share his insights. Vice Chair Jefferson was appointed to the Board of Governors in May 22 and to Vice Chair in September 23. Previously, he was Vice President for Academic Affairs, Dean of Faculty and Professor of Economics at Davidson College. Before then, he served as Chair of the Department of Economics at Swarthmore College. And going back even further, Vice Chair Jefferson was an economist, a graduate intern, and a research assistant at the Federal Reserve. Vice Chair Jefferson is a native Washingtonian, holds a BA from Vassar College, and a PhD from University of Virginia. He has published research on the effects of monetary policy and written extensively on wages, poverty, seniorage, and income distribution. As a member of the FOMC, Vice Chair Jefferson has already expressed his public views in a series of influential speeches that have touched, among other things, on technology's impact on the post-pandemic economy, on financial stability, causes and consequences of elevated uncertainty, and on lessons learned from past monetary policy cycles. Please welcome our very distinguished guest, Vice Chair.
Thank you, Matteo, for that very generous introduction. It's my pleasure to welcome you to the 13th International Research Forum on Monetary Policy. The vibrant discussions you will engage in at this conference and your research more broadly will help us to understand better the origins and implications of uncertainty. I became a member of the Federal Reserve Board just as it was grappling with the economic after effects of the pandemic, a once-in-a-century disturbance of worldwide significance. As a result, I know from firsthand experience that understanding the main sources of uncertainty and how best to make monetary policy decisions in the presence of uncertainty are crucial to policy making. I will take this opportunity to do a couple of things. First, I will review a few historical examples of how economic thinking on monetary policy making in the presence of uncertainty has evolved. Second, I will consider lessons learned from these examples that could influence how monetary policy makers think about the policy choices the Federal Open Market Committee faces currently. In the 1960s, during the heyday of Keynesian macroeconomics, researchers widely believed that monetary policy faced a long-run trade-off between inflation and unemployment, and that the trade-off could be calibrated to keep unemployment indefinitely low at an acceptable cost in terms of higher inflation. Improvements in econometric modeling abounded, and the harnessing of optimal control methods developed in the field of engineering held out the prospect that business cycle fluctuations could be stabilized. There were contrarians, of course, most notably Milton Friedman, who highlighted the necessity of monetary policy makers to consider what they don't know in their decision-making process. Friedman's statement that monetary policy works with long and variable lags was, among other things, an argument against policymakers trying to fine-tune the level of economic activity. In recognition of policymakers' limited knowledge of short-run economic relationships, Friedman advocated for the use of simple rules in monetary policy, such as the K% money growth rule. He argued that rules that focused on monetary growth and that eschewed feedback from macroeconomic variables would work reasonably well on average and avoid the hubris that fine-tuning policy in a dynamic and uncertain world. History proved Friedman right in his take on the importance of uncertainty, even if his prescription of a K% money growth rule fared less well. During roughly the same period when Friedman authored his famous presidential address to the American Economic Association, disputing the purported long-run trade-off between inflation and unemployment, William Brainerd published an influential paper on the implications of uncertainty. Brainerd argued that uncertainty about the power of monetary policy implied that policy should respond more cautiously to shocks than would be the case if this uncertainty did not exist. Brainerd's attenuation principle is a classic example of what is today known as the Bayesian approach to uncertainty. The Brainerd approach to uncertainty consists of two steps. The first step is to compute the optimal policy for a world without uncertainty, that is, the certainty equivalence case. The second step is to adjust that policy response to account for the particular uncertainty under study. One strand of research followed these steps through the 1970s and beyond. A parallel strand of research that embraced at least part of the message of Friedman was also underway. It bypassed the optimal policy benchmark altogether on the grounds that uncertainty is pervasive and sought instead to find simple rules that performed well across a large class of models and for a large range of conditions. Brainerd's insight was important. There are many circumstances in which the principle of gradualism applies. But as I will discuss later, economic research has also found that there are circumstances in which, in the presence of uncertainty, does not warrant a gradual policy response. Jumping ahead to the 1990s, a new economy was emerging. The unemployment rate was below what many analysts at the time judged to be its natural rate, and many FOMC participants and others were forecasting growth above the economy's potential. Chairman Alan Greenspan, however, suspected that technological advances and other forces were fostering a new economy, a sustained period of high productivity that would allow for a period of persistently low unemployment without generating inflationary pressure. In the presence of hard evidence to the contrary, he was able to persuade the FOMC to go along with him by implicitly employing the Bayesian logic of Brainerd's attenuation principle with a disarmingly simple suggestion. Let's just wait one more meeting and see. Chairman Greenspan repeated this message as inflation fell from above 2% in 1996 to below 2% in 1997 and 1998, while the economy added 9.3 million jobs, and the FOMC raised the federal funds rate just once. Around the same time, there was an explosion of interest in simple policy rules for monetary policy, beginning, in most people's reckoning, with the rule John Taylor published in the early 1990s. These simple feedback rules, which specify how central bank's policy instrument would respond to the state of the economy, differed from their predecessors by replacing monetary aggregates as the instrument for monetary policy with a short-term policy interest rate. This research embraced the message that restricting feedback to a small number of key macroeconomic variables would result in a more robust outcome than adhering to the prescriptions of, say, optimal control policies, which in essence impose feedback on all aspects of these models. Whether much of the robustness gain of simple rules can be realized when central banks only use such rules as guides for monetary policy is a topic worthy of further research. The claimed robustness of simple rules across a set of fixed models is arguably only part of their appeal. Another part is the notion that their parsimony presumably makes simple rules relatively easy for households, businesses, and financial market participants to learn. One useful finding was that gradualism in policy setting, in the form of a sizable weight on the lagged policy rate in the policy rule, is helpful for facilitating learnability. In any event, the literature on learning in macroeconomics extended the dimension of uncertainty for monetary policymakers from the cross-section of candidate models to the time dimension of any given model. The bulk of the early literature assumed private sector decision makers were knowledgeable, rational agents, while policymakers lacked detailed knowledge of the structure of the economy. The assumed imbalance of information and knowledge was striking. It was usually assumed, sometimes only implicitly, that private agents understood not only the economic environment in which they operated, but also the policy regime that was in place. Considering this background, some more recent contributions explored two related departures from the assumption of a fixed model with uncertain parameters: time variation in the true population model and private agents learning about the economy. As I just observed, the rational expectations paradigm presupposes that economic agents have a great deal of knowledge about their environment, but policymakers do not know the true population parameters of the model they use. Instead, they must use estimates of those parameters. As Sargent noted, it makes sense to assume that the decision makers within the models that policymakers employ are no more sophisticated than the econometrician who estimates them. Doing so means accepting that the true population parameters of one's model could be time varying, the outcome of the interplay between shocks, uncertainty, learning, and policy. That realization changes the way you think about monetary policy. How might this matter? Let me give you one example. As many of you know, econometricians have found sizable declines in recent decades in response of inflation to the unemployment rate. Taken at face value, these declines in the slope of the Phillips curve have important implications for the optimal conduct of monetary policy. But what should policymakers take from such econometric evidence? Some researchers argue that the apparent decline in the response to the slack in the Phillips curve could be a manifestation of the improved control of inflation by the central bank. That is, policymakers could be the victims of their own success, in the sense that good performance in controlling inflation over the Great Moderation period may have weakened the information content of the data. Now, take this notion a step further, as a strand of the literature does, and suppose that private agents within our models are themselves skeptical. That is, they have doubts about their methods for formulating expectations and making decisions, and that they act accordingly. Economists now have new means of modeling uncertainty, both within a given model and across a set of rival models. These methods draw on theories of ambiguity aversion. Under ambiguity aversions, agents are particularly concerned about the types of uncertainties that do not lend themselves to being represented in terms of probabilities. Agents' choices are motivated in part by an incentive to minimize the adverse consequences of these types of uncertainties. The ambiguity aversion approach to uncertainty suggests that to protect against uncertainty over which a policymaker is unwilling or unable to attach prior probabilities, the appropriate response is often anti-attenuation. That is, the policy should be stronger monetary medicine than in the certainty equivalence case. For the reasons I have outlined, there are circumstances when uncertainty might appropriately induce a gradual response, and other circumstances when a non-gradual response to uncertainty may be justified. Furthermore, under either the Bayesian approach or the ambiguity aversion approach, the best response to uncertainty is context-specific and can vary over time. Sometimes the context leads to the same conclusion, broadly speaking, regardless of the approach. One case of perennial interest to central bankers is inflation persistent, where the Bayesian approach, the ambiguity aversion approach, and its close cousin, robust control, all lead to the policy response, to policy that is stronger than in the certainty equivalence case to forestall the possibility of inflation becoming embedded in inflation expectations. Another case is that of crisis periods. Take, for example, the global financial crisis of 2008. During this period, the tension between caution on the one hand and vigorous action on the other hand, as a way to conduct monetary policy in the face of uncertainty, was evident. In September 2007, the FOMC decided to lower its target for the federal funds rate by 50 basis points to forestall, to quote, forestall some of the adverse effects on the broader economy that might otherwise arise from the disruptions in financial markets, unquote. And noted that, quote, developments in financial markets since the committee's last regular meeting have increased and uncertainty surrounding the economic outlook, unquote. In response, in subsequent meetings, the FOMC gradually lowered its target for the federal funds rate by 25 basis points, and in January 2008, decided to quicken its pace by lowering the target by 75 basis points in an unscheduled meeting and by 50 basis points, 75 basis points, and 25 basis points in subsequent meetings. Inflation, however, was rising over that period. By June 2008, it was well over 2% and still increasing, and the FOMC paused its rate cutting. It was a decision that weighed the upside risk to inflation and inflation expectations with the downside risk to economic growth. In September 2008, the circumstances changed precipitously, as did the FOMC's approach to policy. The committee quickly cut the federal funds rate effectively to zero and took extraordinary steps to stabilize the financial system and support the economy. The motivation to respond assertively to the emerging crisis and the uncertainty surrounding it was no doubt attenuated by the knowledge that future policy actions might be circumscribed by a lengthy spell of the federal funds rate at its lower bound, which would magnify losses associated with adverse outcomes. My conclusion, as Chair Powell mentioned in a speech in 2018, is that during crisis periods, words like "we will do whatever it takes" will likely be more effective than "we will take cautious steps." Some clear lessons flow from the history I have summarized. First, when uncertainty is high, policymakers should sometimes act quickly and should sometimes act cautiously. The right action depends on the circumstances. Second, while simple monetary policy rules are appealing for several reasons, rigid adherence to the prescriptions of simple rules is unwarranted. Historically, policymakers have only used rules as guides or benchmarks in setting policy, and there are good reasons for this. It is clearly beneficial to look at the totality of the data to identify changes in the economy in real time, to embrace the risk management considerations associated with uncertainty that factor into FOMC decisions, and to adapt policy to the evolution of the economy. Third, in the presence of a high degree of uncertainty, policymakers benefit from a healthy dose of humility. There are limits to what we know about the economy, especially after periods of economic upheaval, such as a pandemic. Reflecting on the situation we are facing today, over the past year, inflation has come down substantially, but is still running above the FOMC's 2% goal. In March, headline personal consumption expenditure inflation was 2.7% over the past 12 months, based on the Federal Reserve's staff estimates. A year earlier, it was 4.4%. Core PCE inflation, which excludes volatile food and energy components, stood at 2.8% a year ago, in March. A year ago, it was 4.8%. While we have seen considerable progress in lowering inflation, the job of sustainably restoring 2% inflation is not yet done. Real GDP growth in the fourth quarter of 2023 was 3.4%, and I expect first quarter economic growth to slow down, but remain solid as indicated by the solid growth in retail sales in March and February. Recent readings on both job gains and inflation have come in higher than expected. The economy added an average of 276,000 non-farm jobs per month in the 3 months through March, a faster pace than we have seen since last March. and the inflation data over the past 3 months were above the low readings in the second half of last year. My baseline outlook continues to be that inflation will decline further with the policy rate held steady at its current level, and that the labor market will remain strong with labor demand and labor supply continuing to rebalance. Of course, the outlook is still quite uncertain, and if incoming data suggests that inflation is more persistent than I currently expect it to be, it will be appropriate to hold in place the current restrictive stance of policy for longer. I am fully committed to getting inflation back down to 2%. I would like to conclude by saying that in this environment of heightened uncertainty, it is increasingly important to comprehend what is driving uncertainty and how monetary policy might play a role in limiting the negative impact of uncertainty on businesses, households, and financial markets. Many of you in this audience have devoted a considerable amount of time to understanding the intricate link between uncertainty and economic outcomes. Your work has enriched our collective knowledge and has been instrumental in helping us policymakers to understand the complexities of our decisions. Please keep it up. Thank you.
Welcome again. My name is Ania Lipinska. I'm an economist at the Federal Reserve Board. And I would like you to welcome to the first session on inflation and macroeconomy in a global context. And before I invite our first presenter and discussant, let me give you rules of the game. So we have 25 minutes allocated for presenter and 10 minutes for a discussant. And then we will have 10 minutes for a general discussion. And for the audience, please raise your hand and wait for the microphone so that our discussion is going to be heard also by participants that are watching us online. One thing more, I will be showing reminders about 5 minutes and 1 minute of, before the end of the allocated time. And the last thing, we have 3 papers in this session. After the first paper, there is going to be a coffee break. And I think that with that, we can start, and we can invite Sebnem Kalemli-Özkan from University of Maryland and Andrea Raffo, discussant from Minneapolis Fed. Yeah, you can. I will sit here.
I'm going to put my stuff here. Wear a mic? Which one is better? No,
this
I just okay. Okay, all right. All right, great. Thank you so much for inviting us to present this paper at this distinguished event. This is joint work with Julian DiGiovanni, who is at New York Fed, and Alvaro Silva, my graduate student, sitting there, joining Boston Fed, Mohamed Yildirim at Harvard, and Koch, and myself, of course, given the 2 Fed authors, the usual disclaimer apply. So the motivation for the paper is extremely straightforward. I'm just going to repeat what you already know, although we started working on this agenda in 2021 when the things were not that clear. Hindsight is 2020. Now we all know what happened. So countries around the world have suffered the highest inflation of the last 4 decades. At the same time, when they were suffering this inflation, they witnessed collapse and rebound in domestic demand, GDP, and international trade, consumption substitution from services to goods and back to services, and of course, labor shortages associated with pandemics and lockdowns and recovery. So since 2021, we have written 3 papers, and we argued forcefully that global supply chains played a critical role in amplifying shocks within and across borders. One plus of this is the fact that macroeconomics in general and central banks woke up to the importance of supply chains and production resilience. Why this is a good thing? Because all the future risks now we are looking to, meaning things like geopolitical, climate, AI, fragmentation of production, really requires a framework as this one, and we wouldn't have either learned this, used this for quantification without, of course, the COVID shock and without this inflation we suffered during the last 3 years. Okay, let me highlight the importance of looking at this issue globally. Why? Because supply chains are global. This is the production and trade network. Generally, we think this as the trade network, the figure on the left in blue, and we kind of tend to ignore the figure on the right in pink and orange and red. And I'm showing you this instead of like a big network figure you used to see, like a big ball with many, many lines, because then I believe you wouldn't appreciate this point that you really need to think the domestic input-output linkages shown on the right in red, regardless of the fact that the sector is tradable or not. Dark sectors there like electronics will be tradable, light pink like wholesale, retail, construction, non-tradable. Regardless of that, you need to envision that figure inside the blue network. Here I also show the most important trade linkages, and the darker the country more open, like European countries, lighter like US less open, and the size of the boxes are going to be the size of the countries. So once you imagine the red figure inside the blue figure, you realize what a complex situation we are dealing with. So this is 65 countries by 44 sectors. So what we do is we are going to take this to the heart, the picture I showed you, and we are going to quantify this well-known narrative by now. Here the narrative is very well summarized in this quote from Chairman Powell from his speech in fall 2023 Jack Pollock conference. I'm underlining 3 things here that we are going to pay specific attention. The first, resulting supply and demand imbalances because of the pandemic disruption leading to large increases in prices of goods. This is the situation in 2021. In 2022, as Art underlined in his speech, a new shock arrived because of the Russia invasion of Ukraine, affecting energy and commodity prices. And then, of course, the final piece, to bring the inflation down, the monetary policy tightened to slow the growth of aggregate demand, allowing supply time to catch up, which is just what Vice Chair Philip Jefferson told us. It is taking time, especially in the labor market, for labor demand and labor supply come to equilibrium. So we are going to develop a new global network model to quantify price effects of these type of demand and supply imbalances and show you each phases of this narrative, which shock was more important, how it transmits across the globe. The point we want to make here is, again, doing this in global open economy as opposed to closed economy is going to be very important, because open economy channels here are going to be important in terms of transmitting both the cost push shocks and also the demand shocks. Now, of course, at this point, again, compare yourself to 2021 and now we say, well, gee, we just missed the importance of the supply shocks. Once we understood that, once we understood the bottlenecks, shipping problems, and all these issues combined also with energy shocks, then okay, then now we understand why inflation came down quickly. That's basic economics. Fair enough. However, that happening without an increase in unemployment is not basic economics. Okay, and I believe we still don't have a good understanding of that. So what our paper is doing is show you that disinflation without a recession is possible, theoretically, and at the same time quantifying the empirical effect of the supply shocks, both in terms of labor and also energy and demand shocks on inflation. So we are going to estimate a multi-country, multi-sector new Keynesian model to quantify the drivers of pandemic-era inflation, as I told you. The picture I showed you was 65 countries by 44 sectors. We are not going to do that today. I'm going to show you 4-country, 44-sector results. What are the 4 countries? United States, Euro area, Russia, and we bunch China and all the rest of the world together. This setup is going to allow us to feed a very rich set of sectoral and aggregate shocks, including shocks to consumption demand by sector, labor by sector, energy shock, which is going to be very important, and how these transmit through global trade and production network. Now, remarkably, this is actually a very parsimonious model. We are not going to be targeting anything. We are not targeting anything in this model, but we can match the observed headline inflation rate in these countries together with the changes in the sector-level prices as in goods sector and services sector, sector-level wages, real wage, and also the exchange rate and the current account. The key results. Negative supply shocks to factors of production. Now, when I say factors of production, entire shipping story and also labor, both labor and intermediate inputs, which can be both domestic and foreign origin, initially spark inflation in 2020, 2021. This is very important for the inflation to start. Then positive aggregate demand shocks, and you can link the positive aggregate demand shocks to fiscal stimulus if you want to, although we are going to do it just simply with higher nominal expenditures. Those type of shocks are going to widen this already opened demand and supply imbalances because of the pandemic disruptions. And that is going to amplify inflation in 2021, 2022. The reallocation of consumption between sectors, goods and services, transmit these type of imbalances through countries, which is of course going to be captured by the current accounts. Energy shocks, of course, super important, but they are going to have differential impact on countries like Euro area, UK versus United States. Why is that? Because of the higher foreign content of trade combined with complementarities relating to energy and domestic and foreign factors of production. This is stronger in Euro area countries relative to the United States. So we are going to be relating to a large literature that is now working on inflation, and we are trying to cite everyone, but if I am missing any papers, please let me know. Let me make the point that, so we are really in this open economy space. There are several now these type of network-based closed economy models, but once these models taken to the open economy, because of the complexity, generally the shortcut is taken, which is tradable and non-tradable, just two sectors. And that's not going to allow you, you can still get insights, of course, from these models, but that's not going to allow you to do a serious quantitative exercise, empirical exercise, which is what we want to do. In terms of the empirical work, again, I believe our ECB Sintra paper done in 2021 is the first that quantifies the supply chain disruptions on inflation. Of course, there has been several pieces of empirical, that's model-based, because in 2021 we didn't have any data, barely some shipping data, but no data at all. Of course, once the data came out, there were a lot of reduced form empirical work that uses VAR restrictions to decide what is demand shock, what is supply shock. So our contribution to this literature is a structural network, New Keynesian general equilibrium model, where we have the global I/O linkages, endogenous response of exchange rate and the current accounts, and also we use empirically estimated elasticity of substitution, and these elasticities of substitution, if the goods, intermediate goods, or final goods are complements or substitutes, also factors with the energy is going to be very, very important. Okay. So the model sketch. So we are going to take the Bakai-Fahri closed economy model. This paper is published in May 2022 AEAR, and we will turn it to open economy. We are going to do some simplifications. For example, it's not a dynamic model, it's a two-period model. We are going to not look at hand-to-mouth agents, just simply regarding households and so forth. Monetary policy, we are going to start at zero lower bound. Perfect competition, we are not going to create any distortions so that we have to assign things to markups. We are not going to do that. Perfect competition in factors and good markets. We are really going to work with only two frictions: downward nominal wage rigidity and segmented factor markets. When I say segmented factor markets, of course, it is going to be very important for labor because of the downward nominal wage rigidity, but capital is there too. Capital is also segmented. The way to think about this is really try to capture the pandemic year's reality, both in 2021 and 2022. What was that reality? When the pilots fired from the airlines, they didn't come to your home and build your home office. So they didn't move from services to construction. That's what the segmented labor market assumption is going to, factor market is going to capture. Okay, the intertemporal approach is going to be super standard. So if you will, the outside shell of the model is your standard two-period open economy model. Within that shell, we are creating this disaggregated production structure. So period 0, period 1, the standard optimization, there's a domestic bond in local currency for the monetary policy, a world bond in the world currency, think that is a fictitious currency right now. This is going to be international traded. Exchange rate epsilon is going to give the price between the two. There is the IN, domestic interest rate. There is the IW, world interest rate, and this phi n is multiplying the consumption in periods 0 and 1 are going to be our intertemporal shifters. When you want to shift the demand across periods, which of course then combined with the disaggregated structure, that's also going to help us to capture shifting intratemporally consumption across sectors. Optimality condition, you have your standard yield equation, interest parity condition holds. From now on, we are going to say, okay, let's assume all steady state values denoted with bars, and 0 is the present period where I'm going to introduce all the shocks, and 1 is this future period, and that's when everything goes back to steady state. Remember, it's the perfect foresight model, so it makes very sense to undertake this. And we are going to do the Cobb-Douglas preferences for consumption. We don't have to, just to keep it clean, and the production, of course, we are going to work with CES. Exchange rates and monetary policy. So the world interest rate is endogenous here because the world is, of course, a closed economy. That's going to be determined by these demand shifts. Bilateral exchange rate is only going to be determined by the relative stance of the monetary policy. So if IN is the US and IM is the euro, and then they adjust the monetary policy at different times, that's going to read you the bilateral exchange rate. We are going to start with 0 lower bound, not first moving the monetary policy. So that is fixed. Bilateral exchange rate is not going to move because 1 plus IN is 1 for all countries. But of course, multilateral exchange rate is going to move because world interest rate is an endogenous object and the parity condition also. I will show you that how we match the dollar exchange rate, broad dollar exchange rate later on. And then when there is a demand increase in country N, that's going to increase the world interest rate. That means that country's exchange rate is going to depreciate vis-a-vis the world currency. Now the disaggregated consumption. Consumption is going to consist of several goods, as given here with their shares. These country-specific sector consumption bundles, of course, are going to be formed by varieties. This is an open economy, so you are in country N, you are going to be consuming all these J sector goods, and there's a country M out there where you're also, of course, importing from. Then production is going to be done by value added and intermediate bundle. Value production is standard, and value added is going to be with labor and capital, L and K. Again, that's going to be specific to your sector I in your country. Now, an important thing here is, of course, to be able to get at things like supply chain disruption and all, these intermediate bundles are going to be consist of sector-specific bundles, Z, and that's going to be formed country-specific bundles, X. What is this really? So steel, say J, comes from several countries into the United States, Brazil, China, Turkey, and so forth, okay? So the US puts this steel bundle together, X and J, to use different industries. Steel is going to be used in the automobile industry, construction industry, manufacturing industry, and all that. And that's what's going to be the Z, okay? Market clearing, goods market going to clear. Obviously, intermediate goods X and the final goods C is going to make up the income, where, of course, these things are coming from different countries. Segmented labor market assumption is going to be very important here because to combine with nominal wage rigidity in your local currency. Pink is local currency. As you see, the pink W is your local currency downward wage rigidity. Green is the world currency, okay? So that gives you the first condition with the exchange rate downward rigidity, and the other one is the fact that labor cannot be more than that fixed labor in that sector. Obviously, for clearing, this equation that you see on this slide has to hold. Okay, so I don't know if I can show you, but that's that. In the capital markets, the same thing, but there are no price rigidities there, so there is no action going on there. And the asset markets are going to clear, and that's going to give us the endogenous trade balances and current account balance. Let me give you the intuition with this slide. So this is true for all the factors. F refers to a factor, but think labor markets for now, because that's really where the issue was during the intense episode of inflation this period. So y-axis is the wage, x-axis is the labor, and then labor supply is fixed with the vertical line, labor demand is downward sloping. So we start at the point A. Originally, of course, because of the fact that it was a pandemic-related shock, labor supply shifts in, you go to a point like B, but then what happens is countries go to recession, so labor demand goes down. So because of downward wage rigidity, now you're at C. That Keynesian employment is called Keynesian employment by these papers like Bakai Fahri, Veronica Guerrieri, Ivan Werning, Ludwig Starp, and there are several papers did this type of insight in closed economy showing this effect. So this is the first phase. Of course, to understand inflation, this is not relevant, right? We now think about the second phase when recovery starts. Labor demand started recovering, and then we are somewhere along that dotted line. Point E maybe a lower point, you are coming towards the A, but that's exactly what Vice Chair Jefferson was referring to. This coming back to balance of labor supply and labor demand is taking time. And this model is going to allow us, where are we, using counterfactual, how long, not how long, but how we are coming from that B, E, and down towards equilibrium. And then what is the inflation during that catching up process? What are we going to do to solve this model and calibrate? We are going to first need global trade and production network data, the blue and orange figure I showed you. That's going to come from OECD. That's, of course, going to be used pre-pandemic. All the expenditure shares are going to be obtained from there. Then we normalize all prices at the steady state. We start at the pre-pandemic steady state, that's 2018, 2019, and then shock everything and use a nonlinear model, use a nonlinear optimizer to solve the model. Calculate everything in common currency, convert them to local currency because we want to go to inflation every country, and for that, obviously, we are going to use the model exchange rates. Let me give you intuition for the inflation. So we are going to use several matrices to do that. First, the top one is going to be telling you your consumption shares. The second one is going to be the sector shares. That is, of course, going to be the Leontief inverse, and the final one is going to be the factor share. So what we are trying to do is like, okay, for US consumers' car consumption, the fact that parts of that car come from other countries and other labor used for that car production, that is all going to be taken into account in the last term, okay? That is going to be very useful because then I can think about any price in the economy. That's equation one. Think about price of steel, price of lumber, price of used car, you name it, whatever you want. That's going to be, the change in that price is going to be a function of productivity, D log A. If certain, goods production becomes better, of course, that's going to be disinflationary. And the factor cost goes to that goods production, that W there, the labor, right? And they are multiplied with their respective shares and Leontief inverse. Then you make this for all the goods, go to CPI, that's equation 2. You are going to have basically the same thing weighted now depending on each good's weight in the consumption basket. And of course, there's an exchange rate adjustment because some of those goods are going to come from other countries. Then you can use the global donor weight, that, triangle, big lambda, and you can take out the wage, which will help you to get at this local slack, global slack type of phenomenon. Okay, that gives me this first degree approximation to inflation equation. Let me tell you, and then I will show you the quantitative result, which is, of course, going to come out of the nonlinear model, and then I will conclude. But I really want you to show this first order approximation to inflation because it really crystallizes the intuition. So this is CPI N. N is US, UK, Germany, Euro area, and N is the country. Now this first term is the exchange rate, obviously. That's going to pick up the intertemporal shifter effect, the standard open economy channel. Then you have this minus productivity shock. Again, delta log A, any productivity improvement is inflationary, but that's multiplied with that lambda N. It's going to depend on the donor weights of that good, and also from every country. So if steel production improved in somewhere else, that's going to be disinflationary in your country. The third term, the same intuition for the labor. The factor changes. Of course, all factors are going to come here, but here it is the labor representation. Again, any labor shortage is going to be inflationary. There is a minus sign, so when you say, where are the workers, that's inflationary. And how much? Multiplied by the delta and lambda weight in front of it depends on, again, how much you use in what sector and how much of that is from another country. And the last, that's going to be, of course, an endogenous object. And the last term, what we call local global demand-supply imbalances, that's a very important term because that's global factor shares in terms of local factor shares. If everything changes the same proportion, then that firm is going to disappear. That firm is going to be zero. And that's exactly why doing this in the open economy is very important because think about it. If world demand increases in semiconductors, chips and all that, and then if your country, N, is also demands that, that's going to be inflation in your country. That's going to be captured with that asymmetric demand and supply in that last term, only will enter in an open economy because the first three terms, well, exchange rate is not relevant, but the productivity and the factor change can also enter in a closed economy, except they won't be weighted with the global vectors, but they will be there. The last term, this local global demand supply imbalances, is going to come from open economy. Let me show you the results and conclude. So for the shocks, we are going to use sectoral consumption data, sectoral labor supply data hours. For country-level aggregate demand shocks, we will use normal expenditures. And for energy, we are going to use the IMF Commodity Price Index. Elasticities, it's important. I don't have time to go into details, but we are going to use all these elasticities between value-added intermediate input, labor, and capital among intermediaries, all as estimated in the literature. Now, the first three are not that debated. The big debate on this elasticity business is the last one, cross-country Armington. You can see we are going to use a value very low, 0.6. The literature, entire literature before the pandemic, uses that value as 4.5, where goods are really substitutable, because that's the long-run elasticity. We are trying to understand inflation within a period, within a year. So we want to use the short-term elasticity, which is 0.6, estimated by Boehm, Levchenko, Pandalay in their recent AER paper. Then to start from the point of, well, we are looking at a very short period, and as argued by Vernalt, and there weren't any major productivity changes and labor allocation across sectors, we are going to just set that productivity term 0. So we will be working with that local global demand-supply imbalance term, and then the shocks to labor. Okay, here are the results. So on the left, you see United States, on the right, euro area. The black line is the actually what happened, the data, headline inflation. You see, we do remarkably well for such a parsimonious model that is targeting nothing. We missed 2 points, the rebound point and the COVID lockdown. The diamonds as us, what is predicted by the model, and the black is the data. With the exception of those misses, the rest is fitting very well, both in the United States and the euro area. Then we do this counterfactual and say, imagine a world where only supply shocks happen. Imagine a world where only energy shocks happen. Imagine a world where only demand shocks happen. What would have been the inflation? Okay, that is this exercise, and this actually makes it very clear how different shocks were important during different times. Look at the United States. Originally, without the supply shocks, we would have deflation. Okay, we didn't have deflation because of the supply shocks. Later, in 2021, 2022, actually, inflation would have been higher in the United States without supply actually improving and pulling it down, because the red crosses are what is coming from demand, purple dots are what is coming from supply, green is coming from energy, and yellow is coming from sectoral demand shifts. Energy, you see, not that big a point, like less than 1 percentage point as to inflation in US, but look at euro area. Almost 2 percentage points, even a little bit more, added to inflation of the euro area because of the energy shock shown, especially in 2022, shown in green. Then we do domestic international. So this exercise has, okay, imagine all the shocks happened in the United States, nothing happening internationally, that's orange. And imagine all the shocks happen internationally, nothing happened in the United States, that's the purple. So as you see, United States, domestic shocks were more important. Euro area is exactly the opposite. Euro area wouldn't have that high in inflation without the international shocks. That's the way to read this figure. This is the model implied multilateral exchange rate. USD dollar broad index exchange rate is in the black, and what our model implies is in the blue diamonds. You see that we predict the depreciation extremely well without having any financial factor in the model, because that exactly comes from these demand shifts as the model tells you. We don't do as good a job in the second half appreciation, because that's when, of course, US monetary policy tightened before the other countries, and we don't have that tightening of US monetary policy in the model, so we don't capture that appreciation. That's what we are working on right now to introduce that, so that that second part we are also going to match better. This is US current account, which is again impressive. The deterioration in the current account pretty much until early 2022 captured very well by the model, and then the later improvement in the US current account. US real wage change. The model can capture very well the original increase in the real wage and then decline and then smoothing out as happened in the data. And these are the sector-specific real wages for goods and services and durables inflation, energy inflation. The model also does a good job in that. Conclusion. It is extremely difficult to quantify drivers of the inflation and disinflation during this era. Why? Because we have the real shocks and we have the policy response. And it's actually very, very difficult to separate this in such a short period of time with any model or with any data. Obviously, there were these temporary disruptions due to lockdowns and fear of infection, leading to supply chain bottlenecks. Then we have the Russia and Ukraine shock. During this period, there was fiscal and monetary stimulus. Governments intervened, rightly so, to help unemployed. So meaning purchasing power was sustained, even economy's ability to supply goods really, really shrank. That means inflation. That's the natural consequences. This is why prices of the items increase due to global factor shortages before the domestic wages. So our argument in this work is we need a global macro network model to understand really this episode and quantify the drivers of 2020-2023 inflation. Thank you very much.
All right. Thank you very much for having me here. And thank you for the opportunity of reading this paper. It was in my list. I saw the Sintra presentation, so I was curious to see how things had evolved. Usual disclaimer, I'm talking for myself. So if you are in this room, it's probably because you're interested about inflation. So this paper talks about that. That's the key fundamental question. What I like about it, this talks about what generated inflation and how did they transmit across countries. So clearly there's an emphasis on open economy dimension. What's the technology that they use to address this question? Very rich global I/O structure to basically back out both shocks and transmission. You can think of it as a Baki-Fari 2022, which actually was produced 3 months after the first wave, so it's a 2020 paper. Applied to open economies. So 4 blocks, 44 sectors, very rich network, 2 periods. These are the key elements, 2 periods. Downward wage rigidity is the part of the New Keynesian aspect of it. Sector-specific factors, capital is fixed. They're going to solve for perfect foresight equilibrium. And then the beauty of it is that they're going to use 4 aggregate observables to basically trace out these shocks and how they transmit across countries. So aggregate and sectoral spending, sectoral hours worked, and energy prices. Those in IF that used to work with me when I was here, you might remember I always thought this was the future. I remain with the idea that this is the technology of the future. So this is a frontier. It's a great contribution. What are the key findings? They actually tell you a very reasonable story. You can open the newspaper and pretty much find some of those words. Early on, very negative supply shocks, but also demand collapse. So you don't see much of an inflation pressure. Actually, you see some deflation. Then 2021, 2022, big increase in aggregate demand, some recovery in supply, and then energy shocks, especially for Europe. What I like about it is they put a lot of emphasis on COVID is one shock, which all these reallocation across sectors, and the war is a second shock. This is something that sometimes gets forgotten in the transitory persistence debate. We actually got 2 big shocks that are both inflationary. You see it visually in US output, you see it visually in Euro area output. So I'm going to raise 3 comments. Largely with the idea that the underlying question is what drove inflation and what is the model? The model is very rich. What is it missing? Does that matter for understanding inflation? And if so, how would it change the accounting? And the 3 comments are going to be about static versus dynamic choices, the modeling of monetary policy, and then some minor points. To the extent possible, I'll try to be a good referee in the sense that I will try to offer some suggestion of, okay, if you don't have capital in the model, what could you do to try to approximate that? So what they are doing is essentially solving a very rich 2-period model, and then they are rolling that for the whole 2020-2022 period, assuming always that the second period is steady state. So it's a rolling solution. Everything is close to Leontief. I was talking to Sylvain before, when I reminded him that 15 years ago they had such a hard time publishing a paper where the trade elasticity was 0.6. Now here 0.6 is the highest value you can see on any CES or any. So I was a little bit surprised by that. Obviously that implies that whenever you have this movement, you have big responses in prices. Capital is fixed, labor cannot move across countries. As I said before, it's an open economy version of the Bucky and Fari, though Bucky and Fari, to their credit, they really focus on May versus February 2020. It's very early on in the pandemic. We have this massive shutdown. What are the implications of those? So the first question I'm going to raise is, well, if you find yourself trained in representative agent macro, where you worry about state variable like capital, debt, current account is essentially what you use to transfer resources over time, do those matter for inflation? This is the question. I believe it does, and they do, and in this chart, what I'm plotting is basically US consumption versus US investment. I think there is an underappreciated element of the data, which is why, in the context of a massive increase of fiscal and monetary policy stimulus, we have not seen a response in terms of adding capacity to the production of goods and services. Investment, as you well know by now, basically consumption is up to 15% in nominal terms. Investment is barely up. So this gives me pause in terms of firms are looking forward and trying to say, should I respond to an increase in demand by raising prices or increasing capacity? We haven't seen the latter, and I think it begs for why. Now, there is an aspect of it that says maybe their assumption that capital is fixed is not as bad after all. So I give you a pass for that. On the other hand, I still think that going back to the technology focuses on this rich network and firm-level structure. Well, at that point, I would like to see to what extent return on capital across these sectors actually has varied so much. Maybe some sectors did expand capacity and others did not. And that I would find a little bit more of a test of the theory that in the cross-section, I'm actually doing a good job. And you could do that to the extent possible by tracking investment rates for some of these sectors that you are looking at domestically and abroad, and trying to see to what extent the capital stock is moving differentially in some of these sectors. Again, I'm trying to raise points in terms of how does this affect the accounting of the shocks of demand versus supply that the paper is after. And part of the reason why I'm raising this is that when I look at this picture, basically the underlying story is one where two shocks really matter. The red one and what looks blue-purple. Early on, you have aggregate demand down, and then the sectoral supply shocks up, and those offset. Later on, massive aggregate demand, and the sectoral supply shocks actually are now helping on the inflation front. But if you look at the contribution of energy and sectoral demand, very little, which was a little bit of a surprise, given that we have thought about people didn't want to go to a restaurant, they all wanted goods. So I was expecting, my prior was that there was going to be a much more role for this sectoral demand reallocation, and the model delivers very little. So I think that would be a point for you to clarify. In the background, there is also a bigger question, which is we are basically compounding in this aggregate spending series anything that has to do with an aggregate demand shock, a fiscal policy shock, and a monetary policy shock. Which leads me to point number two. I think obviously the model is very rich in terms of cross-section, so they have to make some assumptions in other parts, one of which is how they treat monetary policy and exchange rate. As Sabine mentioned, they basically assume policy rate at the ZLB, no implication for bilateral exchange rate, multilateral exchange rate, think of it as consumption in one country versus another. I mean, I spent my whole career at the Federal Reserve. I find it a little bit crude as a way to go after monetary policy and exchange rate. And in particular, because monetary policy does change quite a bit in the sample that they have. Let me show you a chart. The red line is 10-year rates. The dark blue line is the federal funds target rate. And then the dashed line is the SEP. September 2021, we are at the ZLB. Your assumption, you might say, is appropriate. Then we start moving to 2022. Actually, we haven't even changed policy rates. We are communicating with the SEP. We're going to raise. Well, look, 10-year rates, 100 basis points up. Monetary policy is moving. Then you go to later in 2022. Policy rates are at 5%. So this assumption of ZLB throughout, I find it a little bit restrictive. It might affect the distribution of the importance of demand versus supply shock. Obviously, it has implication for exchange rate. In my job market paper, I was talking about exchange rate, and everybody told me it's all about asset market, nothing about real. Here, it's all about consumption in two places. Everything is real. It is important here because it matters for the new Keynesian block of the model. It basically, all these constraints about wage rigidity are about cross-country rigidities. And honestly, when I look at this chart, I think, as you indicated, basically, especially in the second half of the sample, probably we're missing something in terms of monetary policy and exchange rate. Let me offer a suggestion. I think you can solve the issue that they're trying to deal with is that they have too many equations. They need to basically put down some assumption to be able to solve the model. But I think you should be able to even consider interest rate as a parameter that changes over time. So instead of 0, you can put numbers and try to solve the model that way. Why am I saying that? If you are in this building, the big question that you always face is, were we late? Were central banks around the world late? I would like to run some counterfactual. And I would encourage the authors to do that. Some minor points. First, it would be interesting to see how important is this wage rigidity. Is that the key New Keynesian feature that we should think about? Early in the pandemic, perhaps, 21, 22, when you see wage growth going through the roof, I'm a little bit more skeptical, but there might be cross-sectional dispersion in terms of some sectors still might face that, and maybe that's an insight that comes from the model. It would be good to plot that in a chart. Why does it matter? It is a key to understand whether monetary policy had any scope to provide accommodation or not, and so on and so forth. Second point, again, minor, but whenever there are, my reaction to very large heterogeneous model, I would like to see some discipline coming more from the cross-section and just not from the aggregation of all these sectors into aggregate GDP, aggregate spending. So I would encourage to pick some moments of the data where you see that, for example, like cross-sectional dispersion of prices in the model and in the data, more or less, are not too far off. And actually, Baki and Fari have a nice scatter plot where they try to say, look, this is our evidence that whatever we saw in terms of the early on in the COVID phase actually does line up with what the model implies. And a minor point at the end is, I understand in a very short period, factors can be sector-specific. 3 years down the road, this has been a story of people moving from goods to services and things like that. So it affects a little bit the extent to which once you increase the amount of the L bar, amount of labor supply in a sector, you are effectively talking about people moving from one sector to another. So there is reallocation, essentially, and this affects the inference in terms of the labor supply shock. So let me conclude. And when I put this slide, I submitted it, and then I said, oh, I'm not sure if I'm talking about this paper or I'm talking about the AI. But anyway, this paper is about the most important question that we are facing, and it's hot, almost like AI is hot nowadays. You cannot escape it. For sure, there will be application coming into in the future. I look forward to seeing those. That said, I think especially for questions like what drove inflation, there might be some elements that right now are technologically difficult to handle. Obviously, you cannot have many sectors, many state variables, and so on and so forth. But I'm sure that in the future, those, both in terms of dynamic choices, monetary policy, will be there. Thank you.
So we have time for questions.
Thank you very much for a very nice presentation. Just a question, so when you were dividing things between, let's say, the US and the Euro, and you were looking at aggregate demand, so how do I interpret that? Is it the idea of the aggregate demand within the area that's kind of doing it? And so could I look at the aggregate demand effects of kind of like the US on Euro? Is that kind of a breakdown? Just trying to understand what was exactly in that graph. Thank you.
Great paper. I was surprised by your picture on energy prices. I was expecting more of an effect in the euro area than in the US, given the size of the shock. Just the direct impact was much bigger on inflation, and then if you take account of the indirect effects on sectors that use energy intensively, I mean, we come out with a very different conclusion with Veronica Guerrieri, Lucrezia Reiklin, and Michela Markusen.
So I have a question on your the composition equation of inflation. So the first term is the change in the exchange rate, right? What's striking there is that the pass-through of exchanges onto prices is 100%. And so I'm wondering what's the quantitative contribution of the depreciation that you showed you were able to match, right, in explaining the first run-up in inflation, when more realistically, you know, the pass-through is much more incomplete in reality.
Yeah, great paper. I want to follow up on the question that Andrea asked about the persistence of inflation. And in your decomposition, I couldn't see anything about inflation expectation. And here we spent, of course, a lot of time. And in 2021, one thing that really increased is short-term inflation expectation. The year ahead just went through the roof. And I'm wondering if this is a consequence of having a two-period model, or if there's something like that that you could tackle. Thank you.
Great paper. Just kind of following up on some of the previous questions. What's the contribution of the nonlinear solution in the model compared to the first order approximation that you showed to give the intuition? Do we gain a lot by doing all this sophisticated analysis?
All right, okay. Let me first ask Alvar if you want to say anything. You can definitely come, and you have a microphone there too. Just let me, all right, okay. So first of all, thank you very much. Great comments, very well taken. I agree with everything. So I guess nothing much debate. Let me clarify. This came up also in several questions too. Yes, this is not a model right now to take and use at the central bank, right? We don't have expectations, we don't have persistence, it's not a dynamic model, we don't have any of that. So in that sense, if you say, well, I want to use this model for 2023, 2024, you wouldn't be able to do, right? The goal here is really to capture, originally literally to capture a year, at most 2. The exercise is literally stops at the end of 2022, right? So if we want to now extend, we want to turn it to a dynamic model, bring all those things. So that's very well taken. However, given that, it is remarkable how much it can do for the 2021 and 2022 inflation. That's the point we are making. So we see this actually glass half full, not glass half empty. Of course, if you want to do a serious central bank quantitative model, you need to add all these elements. That aside, monetary policy has to be there, for sure. I mean, this is in general for all the dynamics and persistence, but the nominal policy interest rate, that's exactly what we are working on. We couldn't finish, so that's why it's not here. But, and in fact, it's very promising. So once we add the monetary policy, obviously, and as Andrea says, it can be, you know, done as a parameter, it can be done other way. But then, you know, we will capture much better, of course, the exchange rate appreciation and other things. But that's definitely going to be there. That is going to help also these things like when you say, well, okay, now everything is going to be picked up like aggregate demand and supply. less role to, sectoral consumption energy. Of course, once monetary policy is there, that's going to also help this reallocation. So that's going to be much better. So that we are working on. Cross-sectional disciplining, yes. We are already doing sector-level prices, sector-level wages, and we are doing very well there, and we can definitely do more. Returns to capital is a very, very good idea. So we will definitely think more on these and more cross-sectional disciplining. Let me answer this question. So, okay, this is very important. This is actually exactly the open economy intuition. So aggregate demand in Euro area, aggregate demand in US, right? So we right now feed in the normal expenditure, okay? If in a closed economy, you have to treat it exactly as all US consumers' expenditure on US soil. This is exactly not what is happening in the real world, right? So that's actually what the model picks up. So in that sense, what is fit into the model is the US normal expenditure. So, but the model is apportions that properly as, if it went to, goods on China and so forth, right? So in that sense, you use that data, but, because in reality, that's what that expenditure is. So, and the energy, you can have a bigger energy. So we are actually fully consistent with your results, Silvana. The reason why now you see, it is still not a small effect. It's like more than 2 percentage points in Euro. You can even have more. The reason why it is only this much is the way we feed in the energy shock is through Russia energy sector's productivity. That's how it's fed into the model, right? So obviously, in a standard model like you guys are doing, it's going to amplify it because you put it differently. But right now, at a minimum, when you only feed Russia energy sector, then that's what this effect. And with that, we actually get a lot, and we get much more in Euro compared to US. Exchange rate term, it picks up the standard open economy channel, right? I wouldn't read it as a 100% pass-through. It picks up the intertemporal shifter and demand. What is the standard, open economy result with fiscal policy and, aggregate demand shifting and all that? In an open economy, the effect is going to be much smaller, right? Compared to the closed economy. That's exactly actually what is that picking up. So there is nothing new there. In fact, this is the big difference of this paper compared to our Sintra paper. In the Sintra paper, we didn't do the full open economy, and there we had a much more bigger effect coming from the demand side, if you think like if it has a fiscal shock and all that. Exchange rate mutes that effect here. So, and of course, that helps us matching depreciation. Let me say something on this whole exchange rate has to be all asset market. And believe me, I am in that camp. I've written papers where exchange rate is all about asset market equilibrium and risk premia. But here, and the second part is going to be exactly like that because, of course, US monetary policy, working through the financial markets is going to pick that effect. But the first part, I think it is extremely important that it is really coming from the real side. And that's the new insight from work of Oleg Itoshki and Dima München, right? That's how they can explain the 6 puzzles of everything by bringing both the real side and the financial side together. What happened in the literature, we went all real, we explained nothing. We went all financial, we did much better, but we still didn't explain the whole thing. So you do need both, in my view, and actually this is a very, very good period really to understand that you had a real story going on early on, but later, obviously, there's going to be a financial story, so which hopefully we are going to bring. And nonlinear contribution, that's a very, very good point. So the nonlinear, I believe, Alvaro can correct me, but that allows us to see also all the interaction between on those terms that I showed in the first degree approximation. So we can look at that separately, but I believe the nonlinear solution really gives us the power to come close to the actual inflation, because the second order and third order terms are going to matter with this complementarity, right? And this complementarity point is important. Again, Mark has a paper making the same point, looking at the complementarity between energy and labor. I understand it is very, not comfortable looking at a 0.6. I understand that. And maybe as Mark's paper, with energy and labor, it makes more sense to you and not a cross-country trade elasticity. But again, this is very short term. And there is a reason why the trade literature with 4.5 type of elasticities had a difficult time. Now, if we take this to 2023, 2024, of course, then we think about labor substituting across sectors, elasticity going to 4 and all that. In fact, we are doing some of those exercises, what happened, how much we can take. But in the short run, again, we take it from that AER paper of Boehm et al., and this seems to be valid. And that actually also interacts with these second order and third order terms. Now, yeah, let me see what else I'm going to say. Okay, one last point, this substitution thing. if you do the, I mean, this is what we did some of those examples, and if you go to full-fledged the elasticity you used to, like, full substitution, you are going to be much better in terms of matching what is going on with output, and that's actually the work by Benjamin Moll and others on the whole Germany cutting the Russian oil, but you do worse in inflation. That's actually, so this is a trade-off. I mean, yeah, substitution makes a lot of sense for output, but not for inflation. So that's, again, goes to this, what happened in the short-run thing, and I think the most important one is really, as a Marx work, energy and labor, but we can definitely do more on all these. Thank you very much for all your comments.
We now have coffee break, and we meet at 10:45.
Thank you. This is a great
Francisco Fed. And just one request during our discussion, when you ask a question, please first introduce yourself. Thank you.
Okay, thanks so much to the organizers for having us on the program. This is joint work with Pierre and Felipe. We're all at the Richmond Fed, so the usual disclaimer applies. So today we want to talk about how a little trade can go a long way in explaining cross-country co-movement. And we are motivated by this cross-country co-movement in GDP growth and inflation. So here we are showing in the top two panels, GDP growth and inflation for US, EU, China, Japan, and Canada. And you can see visually that they co-move across countries. This has been documented as well for other ranges of countries, different sample periods, and so on. What has been maybe a little bit less well documented is this lower panel, which we are showing GDP growth in country I, the correlation between that and inflation in country J. So if country I equals country J, if J equals I, then that's just the usual Phillips curve. And here, each set of bars corresponds to GDP growth in one country, and the colors correspond to inflation in different countries. And what I want you to see here is that the filled bars, which are the I not equal to J correlations, those are almost all positive, and those are about the same level as the I equal to J bars, which are the ones that are not filled. So all this correlation begs the question of, what's driving this co-movement? Or another way to put it is what explains fluctuations in domestic variables other than domestic factors. And broadly speaking, you can think of two sources of co-movement. One is global factors, so global productivity shocks or coordinated monetary policy and so on. Another way you could think about it is you could have spillovers from foreign shocks through trade in goods or assets. So factories close down in China, that drives up prices in the US because US imports from China. And the tension here is that if you look at trade as a share of GDP, this is small in a lot of large countries like the US, so it's like 80% in the US. But when you look at empirical work, you do find that foreign variables matter for inflation even after controlling for domestic variables. And so the way we're going to think about this is to write down a framework that combines nominal rigidities in the new Keynesian tradition with trade in goods and assets, and this is going to be across multiple large countries. Right, so this is going to be very tractable. It's going to take the simple 3-equation new Keynesian model and add 4 equations per country. And once we bring this to the data and estimate it, we're going to find quantitatively important role for trade spillovers for generating these co-movements. And this is going to come, importantly, from indirect effects through this trade network. So just to make things a little bit more concrete, suppose there are a bunch of countries. Suppose demand goes up in China, consumption goes up in China, wages go up in China. EU and Japan export to China, so wages go up in those countries as well since demand for their goods go up. But then the US exports to EU and Japan, so wages go up in US. But then China also exports to the US, and so on and so forth through the whole network, right? And so we're going to get this Leontief inverse logic through this trade network, and this accumulation of knock-on effects is going to drive up the amount of spillovers, even though we have a small share of trade in GDP. And so what do we get out of this? So the first thing we get is what we call the global Phillips curve. So that's going to just make clear how inflation in one country is connected to real activity as well as exchange rates in all the trading partners. And it's going to have it's going to be very clear what the weights should be on each of these trading partners. Then I'm going to show you a special case where we can get correlated output and inflation, even though demand shocks are orthogonal. So there are no global shocks, but yet you've got spillovers that generate positively correlated output and inflation across all country pairs. On top of that, in this model, consumption is going to be just driven by demand. It's going to be orthogonal across countries as well. So you're going to have positively correlated output and uncorrelated consumption. And this is going to speak to the Beckers-Keyhoe-Kitland puzzle, where they find that in the data, output is more correlated across countries and consumption, but the opposite is true in an international real business cycle or typical IRBC model. And this model is going to have, this special case will have an analytical solution where it's going to be very clear how these indirect knock-on effects show up. Then we're going to take this to the data, do Bayesian estimation, and then we're going to find a few things. One is that, as I mentioned, trade is going to be important. So if we take out trade from the model, right, then cross-country correlations are going to fall by 90% for output and almost 60% for inflation. And then this effect of trade is going to come from this interaction between the global network, the trade network, and these new Keynesian forces. So if we change the parameters so that indirect effects are attenuated, we find that we can reduce the cross-country correlations by almost as much or even more than shutting down trade completely. And then secondly, when we move from the neo-Keynesian framework to a more neoclassical framework, we also find that the correlations in GDP growth and inflation fall by about 50% and 30% respectively. And then finally, as is suggested by the special case, in the estimation, we don't get, obviously we don't get uncorrelated consumption across countries, but we do get consumption that's less correlated than output growth, and that's again consistent with the data. So since this is a short talk, let me just show you kind of graphically how the model works, and then I'll jump straight into the log linearized model. So start with your typical three-equation new Keynesian model. Right, so workers produce these intermediate goods are subject to Calvo pricing frictions, and then they're aggregated to final goods, which are then consumed by households. What we're going to add to that, firstly, is a layer of tradable intermediates. Right, so these tradable goods are going to be used to produce the Calvo goods. So rather than being produced by workers, the Calvo goods are produced by tradables. And these tradable intermediates, they're going to have an Eaton-Cortum structure, and they're going to be produced by workers as well as materials that come from the final goods. So these materials, that's capturing, in a sense, these supply chain input-output linkages within the economy. And then finally, the final goods are also going to be able to be used for portfolio costs. So we're going to have internationally traded state contingent security. That's going to be subject to portfolio costs. And so as these portfolio costs go to infinity, we get perfect financial markets. If they go to infinity, we get financial autarky, and if they go to zero, then we get perfect financial markets. So we can log linearize this, and for now, for exposition, I'm gonna assume that we don't have these materials, so tradables are just produced by labor. That's just gonna make all these equations a lot cleaner. In the estimation, we'll relax that assumption. And everything now is going to be in vector form. Right? So we're going to get the usual three-equation model for each country. Right? So we have the IS curve, the Phillips curve, and monetary policy rule. Now, what changes here is the Phillips curve. So normally we think of the Phillips curve as being, inflation depends on expected inflation plus output gap. Here we're writing that as marginal cost directly. And that's because like a bunch of these usual substitutions that work out in the closed economy model, these break down once we go into an open economy model. So that's going to introduce 4 additional equations per country. So the first one is marginal costs. In a closed economy, marginal costs just depend on input costs within the country. Now marginal costs depend on input costs coming from all over the world. So on the left-hand side here, that's exchange rates plus marginal costs, so marginal costs in a reference country currency. And on the right-hand side, we've got wages in all countries, weighted by this matrix var pi. So this matrix var pi is basically capturing all the import shares. So wages go up in China, that increases marginal cost in the US, and it increases marginal costs more if the US imports more from China. So that's capturing these backward linkages. Forward linkages also matter, right? Because now demand for US goods is not just domestically determined. Demand for US goods also depends on global conditions. And that's captured by this trade balance equation. And here we're going to start seeing these indirect effects come in. So on the left-hand side, we've got the real trade balance. And on the right-hand side, the first term, that's just getting the direct effect. So demand in China goes up, consumption in China goes up, then real trade balance in the US is going to go up, and it's going to go up to the extent that US exports to China, and that's being captured by this psi matrix. The second term is where these knock-on effects show up. So again, you have got this demand shock in China, wages go up in China, that's this E plus W term. And EU is then going to want to substitute away from China because Chinese goods are now more expensive. So that's captured by this var pi term. And then where's the EU going to substitute to? It's going to substitute towards the US. And that's going to increase the US real trade balance more if the US exports more to the EU. And that's captured by this psi. So that's why we get this psi times var pi term. And how much of this substitution is going to go on? That depends on 1 plus var phi. So var phi is going to be this Frechet parameter in the Eaton-Corton framework, which is basically determining the trade elasticity, so how easy it is for one country to substitute to another. So then we still need to determine exchange rates and S, which is these purchases of the state contingent security. And so that's going to give us two additional equations. The first one is just a balance of payments equation. So this is just saying the real trade balance plus your terms of trade, that needs to be matched by financial flows. The second one is going to be financial asset allocations, right? So without financial frictions, this is going to just boil down to the Becker-Smith condition where relative consumption and exchange rates move together. But once we introduce these portfolio adjustment costs, we introduce this asset pricing wedge. The first term is sort of an endogenous wedge, which depends on how much countries choose to purchase these state contingent securities. And then the second term, that's going to be coming from portfolio shocks. So we're going to have shocks to these adjustment costs as well. And so this is going to look a lot like the work by Iskoki and Mukin, where we've got this wedge. And here, notice that these shocks are also accumulation of shocks. So even though the underlying shocks may be transitory, you can get extended deviations from the Becker-Smith condition. So those 7 equations summarize the model. So you can put them together. One thing we get is this global Phillips curve. Without trade, this is just the usual New Keynesian Phillips curve. With trade, this highlights that your inflation now depends also on real activity elsewhere, that's captured by Y and C, and exchange rates in your trading partners. And all this is weighted by import shares, var pi. And all this doesn't take a stand on financial markets, but all of that is kind of captured endogenously in the paths for these variables. So if you want to take this directly into like a reduced form estimation, all the usual caveats apply. So now let me talk about the special case. So again, we want to show how we can generate positive cross-country co-movement with uncorrelated demand shocks and also uncorrelated consumption. So the special assumption here we're going to make is that the Taylor rule is just going to be this forward-looking Taylor rule, R equals expected inflation, plus some monetary shock. Right? And this shock is going to be IID across countries and across time. And we're also going to assume that we have no portfolio adjustment costs. And so the solution is going to be very simple. Consumption is just going to be moving with monetary policy. So the monetary authority lowers interest rates, consumption goes up. And so what we can show is that with these assumptions, for any country pair, output is positively correlated, inflation is positively correlated, and output in country I is positively correlated with inflation in country J. And so you're getting all these correlations with uncorrelated shocks. And how that shows up becomes very clear once you write down the actual formulas for these, for output and inflation. So again, output can be written like that. And here we sort of see, again, the first term is capturing this direct effect. So a monetary authority lowers interest rates, that increases demand. So if that happens in China, then output in the US is going to go up, and it's going to go up to the extent that US exports to China, this high. And again, the second term, that's these indirect effects. So Chinese demand goes up, EU substitutes away from China towards the US. That's kind of the first term in that bracket. But then now US wages are going to go up, and so like Canada is going to substitute away from the US towards Japan, and so on and so forth. And so that's why you get these multiple rounds of effects. And so that's just expanding out this Leontief inverse matrix. And how much of these substitutions are going to take place? All that depends on, firstly, verify, which is how easy it is to substitute across countries, and the labor elasticity, which is going to determine how much wages increase in response to a demand shock. What happens with inflation? Well, the first term here basically shows that inflation inherits some of this co-movement from output. But you've got the second term here, which is capturing exchange rate adjustments. So what happens is demand goes up in China, right? Chinese households want to smooth consumption, so they purchase these state contingent securities in order to do that. That causes the Chinese currency to depreciate, right? And that increases inflation in China. And all this is really just reflecting the Becker-Smith condition. And how much that happens, again, depends on this sigma, so that's the intertemporal elasticity of substitution, right? That determines how much they want to smooth consumption over time. So what about other shocks? All this is, what I've talked about is just demand shocks. In this special case, TFP shocks are not going to change the correlations. And intuitively, what happens is that here, when you have a positive TFP shock, right, your supply increases, but you also have sort of a wealth effect because wages are increasing, and these cancel out perfectly in this particular environment. With markup shocks, that just tacks on to inflation, that doesn't affect output. Of course, all this is particular to this case, and in the actual estimation, that's not going to be the case. So let me move on to the estimation. So the data we're going to use is using those same 5 countries, US, EU, China, Japan, and Canada. We're going to match GDP growth, inflation, interest rates. Those are standard. And we also use exchange rates, since this is an open economy model. And we're going to have a sample period from 2004 until just before the pandemic. So this captures, 2004 captures like most of the time that China has been in the WTO. There's a bunch of notation here. The main thing I want you to take away is that, firstly, we've got 4 types of shocks: TFP growth, markup, monetary policy, and these portfolio costs. And we allow for global shocks in the estimation. So co-movement in the estimation could come from global shocks or could come from trade. And so the question we want to ask with this estimation is, what are the drivers of cross-country correlations? That's the question we started with. And so the way we're going to get at that question is, we've estimated the model, we take the posterior mean, extract the shocks using a Kalman smoother, and then we feed the shocks into counterfactual economies. So we change various parameters, and then we see how, in these counterfactuals, how correlated output and inflation are across countries. So the first thing is, trade is important, right? So if we take out trade, you see in the orange line here that GDP growth correlations drop dramatically. Inflation correlations drop by more than half, and the GDP growth inflation correlation drops by a little under half. And this, again, is coming from these indirect effects. So the way we get at that is we reduce verify, so reducing the trade elasticity, that reduces these indirect effects. And you see that once we do that, the correlations fall to almost as much or even more than in the case without trade. So the takeaway here is multilateral trade is important, and this is coming from knock-on effects. Now with the Becker-Kehoe-Kitlan puzzle, notice that in the estimation we didn't use consumption data at all. So the cross-country correlation that we get for consumption growth, that's 0.05, substantially lower than GDP growth, even lower than in the data in this case. So that's another thing that we get which is the model gets these low cross-country consumption correlations compared to the output growth correlations, right? And and you kind of get this intuition from the model that with demand shocks, with demand shocks spilling over across countries, you can get, in the special case, it was 0 consumption correlation. Here, it's just lower than in the base, it's just lower than GDP growth. So next is this kind of new Keynesian feature. How important is that? And so to think about that, what we do is move into a counterfactual where we have flexible prices. So that's basically lowering the nominal rigidities, which are captured by this data is the Calvo parameter, and also setting tau to a large number. So that's moving towards financial autarky. And we find that GDP growth correlations drop by about half, inflation correlations drop by maybe about a third, and the GDP growth inflation correlations flip. And also, finally, the Becker-Skew-Ho-Kitlan puzzle returns, and you get higher consumption correlation across countries than output. Right, so this is saying that the new Keynesian structure is important for generating these cross-country co-movement patterns that we see in the data. And then finally, we've got a couple of other mechanisms in the model that could potentially be important, so we explore that a little bit. So if we take out this roundabout production, then or we reduce the exchange rate pass-through, so there's a literature saying that there's imperfect pass-through to import costs. In both cases, yes, the correlations decrease, but nowhere near as much as when we remove trade completely. So one point with this exchange rate pass-through is just that this is just exchange rate pass-through to import costs. In our model, even in the baseline, we have imperfect pass-through to final goods because of these nominal rigidities. Okay, so the co-movement is not primarily driven by either mechanism. So basically what I want you to take away from this talk is that we've got this model with multilateral trade and nominal rigidities. And with this combination of mechanisms, this interaction gives us that trade is really important for generating these cross-country co-movements, and it's not even with relatively small trade shares. So I look forward to Sylvain's discussion.
Okay, good morning, everyone. Let me go back here. Well, first, thanks to the organizers for inviting me to discuss this paper. This is just great work. I think it's super well executed, and I think with a little bit more work, it's going to be an influential piece of in the literature. So clearly, it addresses an interesting and relevant question. Basically, what's driving, what's underneath this co-movement in international variable, what's driving business cycles across countries. So you could think about, is this global shock? So like today you think about the pandemic. So the paper doesn't address the pandemic at all. It stops before that. But you might think about, okay, is the pandemic driving output across countries? Or is this these global supply chains that we've been facing? So what are the two, what's the respective contribution of these two factors? And to answer the questions, it's going to build a relatively traditional New Keynesian framework, the SGE approach, but it's going to embed a much richer trade framework, trade networks. It's going to go beyond the two-country world that often we use when you think about open economy macro, and it's going to think about like the richness of trade linkages across countries. Okay, so they'll follow basically the trade literature, the Eatham and Kortum paper that's been so influential in that work. So it's really interesting, and you can take the quantitative implication of trade a little bit more seriously than if you only had two regions. And then the main finding is that trade is really important in driving all those co-movements, even though a priori you might not have guessed that, because the trade shares in terms of GDP is often very small. And so it's kind of thought-provoking in this sense. So I like the paper. I enjoyed reading it. I'll have a few comments in terms of the trade elasticity, the identification of shocks, and then I'll want a little bit more evidence to kind of know if I can trust the model or not. So just in terms of a brief summary of the structure, like when you look at the structure, you think, oh, it's pretty simple. You know, you've got 3 layers. You have 1 layer is of final goods, and they're produced assembling non-traded goods that have sticky prices. So that's the second layer. And that second layer is just using a bundle of varieties of different traded goods, intermediate traded goods. And that's the third layer. And the third layer is really where the action is. And they're all going to difference, all these goods, they're indexed by Z, and they all basically have different technologies, different productivities. And if you're a country and you're producing a good, then you're using labor, and you're using materials. And materials are just final goods. So this is the roundabout production structure that Paul was emphasizing. So a priori, you look at this and you think that's kind of simple, but then you have to determine who's going to be producing what and who's going to be exporting what. And now you have a lot of countries to think about. And so the allocation is not that simple. And you could see this a little bit with Shebnam's presentation before. Because of all those regions, who produces what, who exports what is not that trivial. So the way to make the model more manageable is to have the typical assumption that productivity and shocks follow an extreme value distribution, and here just a Fréchet distribution. And one important parameter in this distribution is psi. And psi is going to determine how much cross-country productivity differentials, for instance, there's going to be, and how much impetus for international trade there's going to be. And once you have that, the great part of this is that then you have simple expressions for import shares. And you'll know pretty simply like who's exporting what and who's producing what in terms of these intermediate traded goods. And so these import shares are just functions of relative production costs across 2 countries vis-a-vis the rest of the world, and these bilateral shipping costs, kappas. So once you give me W's, you give me P's across the world, I'll tell you, okay, what's the import shares of a country with respect to another one. So once you have that, the allocation is much simpler. So the nice thing about the structure, there's a lot of structure, but there's a big payoff from that. So that's interesting. At the same time, the structure is really tight. And you'll see this, for instance, in this parameter psi. The parameter psi here is not innocuous. As I said, it controls the cross-country productivity differentials, but it also controls other things in the model. And importantly, it'll control the trade elasticity. And you can see this here from this equation. That's just the real trade balance that Paul showed a minute ago. And it basically tells you that how much the trade balance responds to relative international price movement. The exchange rates, for instance, will depend on psi. So psi plays 2 roles. And then I went into a rabbit hole reading this paper. On one hand, you'd think, okay, exchange rates are moving. There's not that much impetus for trade. Maybe like there's not too much trade movement in this framework. But at the same time, if you have a low psi, and they'll find a low psi compared to the trade literature, then I was thinking, okay, but then if psi is low, productivity differentials are really wide, so there's more impetus for trade in the model. And given that you have a network, it's kind of biasing, to my mind, to find a very important role for trade a priori. You have more trade, you have a lot of networks, it kind of begs the question if you're not tilting the framework, the analysis towards finding a greater role for trade in terms of driving co-movement. And so what I'd like to know at the very least is how trade is responding, not only in steady state. Trade in steady state is pinned down by the model. So it's completely pinned down, so that's fine. But in response to shocks, how much volatility do we see in trade compared to the data? How much volatility we see in wages compared to the data? So Shebnam had that, for instance, had presented evidence on wages. And wages are going to be important here because they're going to drive everything, all the incentive to trade. So I think a little bit more evidence along those lines so that you can trust the model a little bit more would be important. Now, to the author's credit, they did do something about the trade elasticity. So I'm concerned that low trade elasticity has greater productivity differentials, a bigger role for trade. So they've addressed some of that. They've said, okay, like what happens if we lower the trade elasticity? If we lower psi in the model, what happens to the role of trade in driving these international co-movements? And lo and behold, they find that, in fact, it's the other way around. There's less role for trade. But then I'm not sure you can do this exercise different ways. So this is a ceteris paribus type of exercise. We lower the trade elasticity, keeping all the other parameters constant, and that's fine. But another way to go would have been, okay, fix the trade elasticity and then re-estimate the model. My sense is if you do that, then you're going to get bigger productivity differentials, even greater role for trade potentially. So that's my conjecture. That'd be something to check. So basically, the role of these shocks, global and cross-country shocks, are really critical. And it wasn't clear to me from the framework and from what's in the estimation, what variables are used to estimate the model, how these global shocks are identified. So global shocks to me are just, for everyone else, are just, they're moving output and variable across countries about the same way. And they won't affect trade that much. Trade in relation to GDP, because everyone's moving about the same way. So, without inducing much trade effect. But then there's no trade variables that are used in the estimation. So it's not so clear to me like how you differentiate between these cross-country shocks and global shocks. And so I think what would be great to have, and where the paper falls short a little bit, is that it's a little bit black boxy. So on one hand, they provide analytics, and that's great, and I commend them for doing that. But I think like just seeing how the model responds to shocks with a few impulse responses would go a long way. So do we see variables responding completely differently, qualitatively, to different shocks so that you can use those particular variables to identify the different shocks would be interesting. So I think we would need this to kind of get a sense of how shocks are identified in the model. Okay, so the other thing in terms of shocks is markup shocks. And here, I kind of like what they had in terms of global Phillips curves. The global Phillips curve is really, very similar to what you'd get in a traditional framework. And then you have, so basically reacting to demand, reacting to international relative prices, the exchange rate, and having markup shocks. So Paul mentioned that the model is relatively complex, and you can't do too much with it. That you get that equation, and you can't kind of drill down too much more. So if you have only two countries, I've got recent work with Giancarlo Corsetti and Luca De Dola, where we have a framework with incomplete asset markets. And what you can show in this framework is that you can drill down a little bit more from the relationship they have, and then show that inflation is not only a relationship to aggregate demand, international relative prices. I wrote T here. You could substitute for E if you want. But it's another channel for incomplete markets. So there's a gap that arises for the presence of incomplete markets, and that basically behaves like a markup shock. It triggers the same trade-off, although it's endogenous. And I'm going to mention that because this is where kind of one of the model check that I'd like, that I think is important. So if you look at so in his slides, Paul sent me his slides, and you had a little bit more information about the role of about the estimates of standard deviations of different shocks. And so if you look at those that I circle in green, these are the growth rate shocks and the policy shocks. And, they have standard deviation of about 0.1. If you look at the other ones, the markup shocks and the financial cost shocks, they're much bigger. They're orders of magnitude bigger than these two shocks, which suggests that, they're kind of filling for other things that are missing in those equations. And in this sense, if you look at the equation pi here that I have, my suspicion is that this incomplete market channel that is kind of implicitly present in their framework is not really playing a large role. You haven't presented evidence of that, but my sense is that the departures from international risk sharing and efficiency is probably pretty minor. And so it begs the question of having an additional channel. And in this literature, in terms of international pricing, we know that pricing to market deviations from the law of one price are important, And you can write the traditional Phillips curve as having an additional gap, which I have here as delta, just representing deviations from the law of one price. So Paul mentioned this a little bit. In the model, it's done a little bit more in an ad hoc manner. I think a new version of the paper would be great to have this fleshed out a little bit more so that maybe you have less reliance on markup shocks per se. And just to conclude, I'm going to leave you with one figure here that I think is interesting. So they're looking at the period 2004, 2019, so right before the pandemic. It's kind of an interesting period for trade. So, you have a big increase in trade. So I'm just plotting here the export to GDP ratio for the US, but it's the same pretty much other places. You have the big increase in trade until about 2011, and then a big decline. So the first thing is that it's not so trivial to calculate steady state values over that period. It's not so clear what you take. And also it's kind of a rich period to study. I think one question could be, what's happening? So we see the big decline in trade. Do we also see a big decline in co-movement? So I think that'd be something to continue exploring in the next version. Thank you.
So we welcome questions from the audience. And please remember about introducing yourself.
Very nice paper. Just 3 quick comments. I didn't understand when you were doing the comparative statistics for more or less trade, were you moving the elasticity of that elasticity from the distribution? I thought it would be more interesting to move some measure of trading cost, because that's something that policymakers can potentially affect through tariffs and so on. So that would be interesting and perhaps more exogenous as well. Then in the quantification of the various parts, I mean, you look at the contribution of shocks versus trade, but for sure there's a co-movement also between the two, and you can also quantify what's the role of that co-movement. And given the infrastructure that you already have to calculate those co-movements across countries, you can also look at the contribution of trade and shocks, these global shocks, to volatility. And that's something, again, that perhaps policymakers care more about the volatility than actually the co-movements with other countries. And you can use your frame, your model as it is to do those exercises.
Hi, hi, Felipe Safie. So in my work with Nils Gorneman and Pablo Guerrón Quintana, the elasticity of trade is important, but what was really important was to have time-varying elasticity. So basically the kind of stuff that George Alessandria has been pushing. And then when you use the trade flows to estimate the model, basically that forward-looking trade component informs a lot of the importance of trade. So maybe one way to get along some of the criticism that you were getting would be to have a more flexible way to model the elasticity and actually estimate the process of the elasticity from the data.
All right, thanks for the questions and thanks for the discussion, Sylvan. So just quickly going over the comments. So with the trade elasticity, so the way we do it, when we increase the trade elasticity, that increases the amount that you can substitute across countries, so that's going to increase the co-movement. I think we haven't tried fixing a smaller trade elasticity and re-estimating the model. If we did that, because we are trying to match, because the Bayesian estimation matches the output, inflation, interest rates by construction, all that is going to end up going into other parameters potentially. So, for example, in the special case, the amount of co-movement depended both on the trade elasticity, but also on the labor elasticity. So you can imagine some of that ending up going into those into that parameter. In terms of how the shocks are identified, yeah, it is a little bit black boxy, as a lot of these estimated new Keynesian models are. I think one intuition that you can get is, again, in the special case, what turns out to be important is this psi times var pi matrix, right? So that's going to be, like the model imposes a lot of this structure on how one shock should spill over to all these different countries based on the import and export matrices. And so that's my understanding of how these shocks are really being identified in the data. And one other thing to mention with regards to global shocks, one additional complication is that the trade also redistributes the global shocks, right? So global shocks may be hitting different countries differently. Once you have trade, that redistributes how all this affects the different countries. In terms of the markup shocks, it's, you're right that we get something that's fairly close to complete markets. And the way we think about that is decomposing this wedge between like the endogenous component versus the exogenous component. We get a big kick out of the exogenous component and these financial shocks. I think that's, again, going back to this work by Skokie and Mukin, because we want to match exchange rates, that shock has to move around a lot for you to be able to match all these volatile exchange rates. And then, yeah, in terms of trade, like the two suggestions about looking at trading shocks, trading costs, and looking at volatility instead of co-movement, I think those are great suggestions. I think the reason we focus on verify was just because that showed up very clearly in the formula. So that's what once you adjust trading costs, you're kind of, you're also affecting like the direct effect. So we really wanted to try to isolate the indirect effect as much as possible. But yeah, like that's like, we have a bunch of potential follow-up projects, and with volatility as well. I mean, there's a whole literature looking at like relative volatility of different, like within a country, relative volatility of different variables and co-movement within a country for business cycles and in developing countries, for example, like stuff that Schmidt-Grohe and Uribe have done. So that's all stuff that like we haven't looked at all. We just focused on co-movement for this paper. Time varying elasticities, yes, we could potentially put that in. I think in our framework, I mean, it's a little bit, when we model it as Eden-Cottam, then you kind of need to think a bit about, okay, what does that actually mean? I guess it ends up just being a wedge. If it's like Armington, we just think of it as like a preference shock somehow. So the way we've thought about it is just to fix the trade shares for now, and the elasticities for now. And with this last figure, I think in the end, we calibrate the steady state of the import and export matrices just to, so that we can log linearize around that. And again, this is related to the time varying elasticities. I think there's more work that could be done thinking about how this has moved around over time. But yeah, all these are great suggestions. Thanks.
We would like to now welcome the next presenter, Francesco Zanetti from University of Oxford, and discussant Gianluca Benigno from University of Lausanne.
Okay, thank you. Thank you for the organizer for having me here. This is a joint work. This is a paper about the causal effect of global supply chain disruptions on macroeconomic outcome, theory and evidence. It's joint work with people in 3 different continents, Xiwen Bai at Tsinghua University, Jesus Fernandez Villaverde at Penn, and Hiliang Li at University of International Business and Economics in China. So what we want to do in this paper is to think about supply chain issues. And we felt that those are now central to the policy debate and to the macroeconomic performance, and they go beyond COVID-19. And the reason is because there are many occurrences that they could lead again to supply chain instances like future of wars and geopolitical tensions. In this paper, what we wanted to focus on are two key questions. The first one is, what are the causal effects of global supply chain disruptions? And in particular, especially for policymakers, what are the differences between supply chain shocks from standard supply shocks or demand shocks? And once we identify how these shocks, they operate differently in a model, then we are able to use data to think about what is the causal effect of those shocks. And also, we wanted to go beyond it and think about if we are facing a supply chain, if we are facing some supply chain disturbances, what are the policy implications? Are the trade-off between inflation and output stabilization different? And would that change how the central bank should react to inflations and output? And what are the trade-offs involved with that? So those are really the key questions. And how do we go about it? What are our contributions? Well, we think that we are making 4 contributions. The first one is in the data, because what we do for the first time, we use some machine learning algorithm to transform data on shipping, container ship shippings around the world, into a high-frequency measure of port congestions that will be symptomatic of supply chain disturbances. And this data is public. It's public since 2017, so we have a series from 2017 up to today that can tell us whether the supply chain disturbances build up globally in the world. Then what we do, we develop a simple framework based on search and matching frictions, where we think about how we can identify supply chain shocks. And this simple framework tells us that supply chain shocks, the unique feature of supply chain shock is that they look alike, as I will show you, supply shocks, in the sense that prices goes up and output goes down. But in supply chain shocks, there is a lot of spare capacity that in standard supply shocks you don't have. And that will be the defining features that the model will give us. Then once we have the data, once we have a model that they give us the identification, we can do causal analysis. And we can use standard methods. In this room, I see people that they use it every day. We use the data, the identification, and we use a SVR and even local projection method to think about if we impose those restrictions that we have from theory on the data, how would supply chain shocks materialize in inflation and output fluctuations? And then the final contribution is to go beyond that and use the model to think about how should supply chain shocks change our vision of policy. Should policy be hard when supply chain shock happens and inflation rises, or that would be dangerous? And there we show that actually supply chain shocks are periods in which prices, they can move a lot, but output is constrained. Output, if it's not delivered, if goods, they don't arrive to the United States of America, even if prices goes up a lot, output remains curtailed. And so it's a period when central banks, as I will show you, can be slightly harder on inflation, and therefore they can increase rates to kill off inflation if necessary. So that is what we do in a nutshell. This is a big paper. This is a paper of 172 pages with the appendixes. So here I will be able to scratch the surface. And what I will do, I will give you an overview on the data, how we did the algorithm, what is critical. Then I will do the model, and I'll try to do the model in a diagrammatic, using diagrams, so that I don't need to spend time on Bellman equations. Those are simple. If you do actually search, those are like a piece of cakes. And then I will use those diagrams to give you what is the causal effect, and then we'll go to the identification and monetary policy. So but why do we say we can look at containerized trade as symptomatic of supply chain shocks? because that is what the supply chain literature tell us, and because this trade by containerized ships is 46% of the world trade. And so by looking at it, we really have a pulse, we have the temperature on how supply chains are evolving. So that's why we look at that. And what is unique of this container ship shipping? For us, it's unique that these container shipping are totally exogenous from supply and demand shocks. That gives us an exogenous identification because those shipping does not depend on demand. Those big boats, they're not going to change route because suddenly in Portugal, they want more fish or they want more some particular goods. Those are like buses that they move. Those are like things that they move from one place to another. There are huge penalties in the paper, we outline that. And so that gives us an external instrument of supply chains that is not affected by supply and demand pressures. And also, in what happens in this containerized shipping is that there is no modulation of speed. Everything goes, the boats, they don't stay in the sea. It's a hurry up and wait. The sea is a dangerous place for the boats. They can lose containers. And so that is an ideal index that we can use to think about supply chain issues. Oh, here. Then, how do we think about port congestions before showing you how we use it in our identification? So here you need to think about that this boat goes around the globe and they're like buses. And what happens is that this boat, they go around a port, near a port, and they stage typically, they can stage in an anchorage area if they need to wait, or they go directly to the berth to load and unload. So for us, the congestions is when we will see ships that enter in a port area, and then they stay in anchorage longer than usual. Typically, ships, sometimes they just enter, they go directly to the berth, and they leave. Load and unload, and they leave. And that is what, how we will do the algorithm. That's what I will show you. Why is it important that you may think, well, you know, during the pandemic, the average wait for this boat was longer of 2-3 days at the peak, typically less. And you may wonder, oh, but this is very small. Actually, it's not, because some of these containers are very, there are very few containers in the world, and those few containers are very big. So a big delay of those containers can be huge. So the biggest container of all is the Loreto boat that transports 24K of those containers. It's huge. 2 hours delay of those boats can have huge consequences on trade and on how the supply chain works in the US. Just to give you a picture that my co-author is very affectionate, this is the Loreto. You can track it in real time if you go on Google. Now it's in Portugal. I checked this morning. And you can imagine if this one is delayed of 3 days, how many people will be upset with you. And if that builds up globally, if in Los Angeles, all these boats are delayed, the US economy is going to struggle. And that's what happened in the US later than 2020. So it wasn't immediately. Our measure will show that contrary to common opinion, the supply chains, they didn't start in March 2020, but I will go there. So how do we do then? How do we measure this congestion? So here we use the automatic identification system that is a mandatory satellite device by the trade organizations that each boat needs to have. And that device, every 2 seconds, transmits the position of the boat, the speed, and the heading of the boat. That, as I will show you, it's a critical part of our algorithm. So what we will do, we can track this boat around the globe, and this data is public. We also have done, as I will show you, a devoted website where you can download this data in real time, and you can see how supply chains is developing. And this is the transmitter. It's very cheap. It's mounted in all the boats. And how does the satellite data looks like? So our algorithm looks in this way, that we first look where we see cluster data. This is a spatial algorithm, a clustering special algorithm. And when we see both clustered together, we know that there will be a port. Then what we need to do, we need to sort out, are these both waiting or are loading and unloading? And so we have a two-layer algorithm where we will be able to tell, look, here we have a port. Now let's determine which one are birching and which one are anchoring. And here is where the heading will become important. Because if you are anchoring, the heading will move around. If you are at the birch, it will be on this axis, either on the right axis or on the left axis, because they move. But this is a tricky business. For those of you that they do machine learning, they say, this is very tricky. Why it's tricky? Because each port is different, and the port is dynamics. What is a birch today is going to change tomorrow. So what we had to do, we had, in our algorithm, we had to identify for each port. You can do it manually if you want. People before us, they do it manually, but you can't do like all the ports around the globe. In this way, you can systematize to do about it. But then we need to devise an algorithm that here we are in Los Angeles. So we know that in Los Angeles, the berth is going to be there and the anchoring there. Things might change, but then what happens is that each port is different. So these, for those of you, I think maybe at the board, by the law of large numbers, there will be people that they do machine learnings. There, now you have an algorithm where you can actually then determine whether they are birching or not. And for us, what we will look at, we will do an index based on how many both. We choose 1 month, but in the paper we have for a week, or we have the number of hours. You can choose the measure you like, that are anchoring. And when there are many boats anchoring, like during the pandemic, that is symptomatic of a supply chain. So then what we do our index. And for the index, we identify berth and anchorage places, as I told you. We count, you can choose a frequency. We use the monthly one as a benchmark. And we count how many boats they are delayed compared to the number of boats that they just enter in the port. And then, and that is the index of congestion. Then what we do an average congestion rates around the globe, weighting each port for the relative number of ship visits that there are in each port. So now we will have basically congestion for each port. This is, you can see that, for instance, we have the Los Angeles, the Long Beach port down there, and you have the month, and when it's red, it's more congested. And we have all these different ports through the algorithm, and then we aggregate them in an index that is the average congestion index that we use. Now, one thing that I'm sure my discussant will focus on is the first part of that series. Because this first part of the series, let me see if do you see this little end? Yeah. So in this little end, here is when the pandemic started, 2020. And what our model shows is that it didn't really build up more than usual until 2021. And that can be important for policy, because then when we use our model to think about policy, what we will show is that if there are supply chain issues, then prices become very elastic, output not. So when you have supply chain issues, and when you can go hard on inflation if you need to, and you can do it by depressing demand, standard policy. So that is what we do. Then here we do a lot of comparison, also with several indexes, and we can tell you stories why they are different. And this is our website. So this is a little bit of ad. If you click on it, you can then download the series and see how things are building. Then what we do with that, we develop a model. The model is based a model to study supply chain issues. And what we want to have in a model is a model where we have when you have a supply chain, you have that some goods are not shipped. So there is a lot of abundance of goods that are not used, but still prices goes up. And so how do you do that? We do it through search and matching. We do that the producers, they produce these goods, they need to ship it to the retailers where there are search and matching frictions between retailers and producers. And so you have that if these guys, they have some cost and they cannot ship those goods, the abundance at the producers becomes scarcity in the retail markets, which pushes prices up. And so that is how we will develop this model. We will develop a model that it must have demand, it must have productive capacity, and it must have global supply chain shocks. For us, the global supply chain shocks will be increase in shipping cost. We did another exercise. The model, this is the same as if we do decrease in search and matching between producer and supply, in the efficiency of matching between producer and supplier. During a supply chain, it's more difficult to match and receive parts. So the story I'll tell you now is about shipping cost. I can do exactly the same story. In the paper, we do the same story with efficiency of matching. So in the model, we have producers that they produce goods with a capacity, L, that is given, and is subject to transportation cost. And then we have that these producers, they supply goods to the retailers, and they match in a frictional goods market. And the retailers, they purchase these goods by visiting the producers, and they pay a cost for it. So this is the search cost. And since there are search and matching frictions, not all producers meet with retailers. And when there is a lot of demand, there are a lot of retailers, then it is more costly for them to meet. So prices will go up, but there will be less matches. And finally, there is a representative households that manage demand. That decides demand. So here is the key picture. This is the supply side of the economy. This is the capacity of the economy. And then those are the producers that they do it. And then there are some transportation costs. So only a fraction of those is shipped. And if the transportation cost increases, this green line moves. But then there is a standard supply side that depends on prices. Obviously, there is a minimum price that needs to be imposed because there are some transportation costs, and there are some matching frictions. So if there is a lot of demand, prices goes up, but there is less output. So when there is a lot of demand, when there is a scarcity of goods, there is more demand compared to the supply, this line will shift in. That will be the key mechanism that I will show you when we do the identification. Then what we do, we derive demand. Demand is downward sloping, standard. This is just, and for us the demand is our monetary policy will implement expansion in demand or contraction in demand. When inflation will go up, monetary policy would like to depress that. So there will be a preference shock or a monetary shock, a demand shock of money that will modulate that. And this is the equilibrium. Now, the question for us is how do supply chain operate? So here I'll go directly to, let's go to the demand shock first. If monetary policy tightens, demand goes down, so prices goes down, output goes down, and unemployment increases. For us, unemployment will be the measure of spare capacity in the economy. What happens when we have adverse supply shocks? This is a supply shock, a standard one. Well, then the producers, they produce less, but there is no change in cost. The same proportion of goods that will be shipped. What happens is that there will be a scarcity of goods, so the demand will be higher, tightness will increase, the supply of goods will shift in, and we will have that prices will rise, output will fall, but spare capacity will go down. Instead, when we are in a supply chain shocks, you can think that the only thing that happens is that now it's more costly to ship those goods. So production is the same, but less goods are shipped. Suddenly, there is less supply. So the market becomes tightens for the retailers. And what happens is that there are more such frictions, and the supply side moves in and up because the cost of shippings have increased. But in this process, what we have that prices goes up, quantity falls, but the spare capacity increases because many of those goods are not shipped. That gives us the identification. Then what we do, we mount this idea in standard VAR, in a standard VAR model with sign restrictions, and we think about what really moves. We can have the standard demand and supply shocks, but now the capacity will tell us what is the causal effect of global supply shocks. And so that's what we do in the next period. I'm looking at you for the minute. I'm still okay, right? Couple of minutes, okay. So here, what we do, we mount this in a standard VAR identification. For us, the key feature is that when we look at supply chain shocks, they look like supply shocks that we call productive capacity, in the sense that output goes down, consumption goes down, and prices goes up, but the spare capacity increases under supply chain shocks. There are many goods that are not shipped. Instead, under standard supply shocks, those goods are not produced, and the spare capacity falls. So once we impose that in a standard VAR, what we have is that we see that actually the model gives us that in response to supply chain shocks, output goes down, prices increases, but spare capacity goes up. For us, the spare capacity is unemployment. Output goes down because less goods are shipped. So they remain. So that's your GDP. Yes, yes. So finally, and then I have 1 minute on the policy. When we do the variance decomposition, what our model tells us is that in the outset of the pandemic, there were no supply chain issues. They materialized later on in 2021. What's happening was demand that was lacking, and then the supply chain issues and the supply issues materialized later on in 21. And then from 2022 onwards, it was a mix of shocks. Finally, policy. So here in this graph, what I want to show you is that is policy different? If the central bank modulates demand, there is an inflation that builds up during a supply chain. The central bank says, okay, let's bank down demand. That is this movement. How will the trade-off between output and inflation change? Here we have that in normal time, those are this blue line. When we have a supply chain shocks, many of those goods are not shipped. So we will be on this, the green line will be here, which will create scarcity for the retailers, which will create additional surge frictions, which will move up and bend in this supply curve. And so we have that in that period, now output is curtailed, and prices actually, they can move more, they need to move more to have changes in output, because output now is curtailed. So during that period, it is for the central bank, if it wants to depress inflation, that's absolutely fine. It will have a huge effect on prices, but the effect on output is subdued. And we test it in the data. We do TVARs, and we do like 2 periods when we are in a supply chain and when we are not, and we see exactly that the data give us the answers that are in line with the model, that the response of inflation is large, the response of output is low. And then with that, I think I'll conclude saying that what we did in this paper was to think about the causal effect of global supply chain shocks. We had the first measure of it, and then we use it to think about also policy. And what we show is that supply chain shocks generate stagflation, but differently from supply shocks, there is a lot of spare capacity. So spare capacity goes up. And tightening of policy can be done, and actually is very effective is more effective than in normal times on prices, but with limited effect on output. And I think I'll conclude. Thank you. I think they hanno messo qua.
Okay, well, thanks a lot for allowing me to discuss this short paper. And it's a very interesting paper. It's a very interesting paper. I read it back and forth. So let's But let me say a little bit about the paper. I mean, actually, give a bit of background. Now, of course, we had this surge in inflation, and there are important questions surrounding the nature of inflation in terms of being global or domestic, driven by demand or supply factors. And this paper actually focused on US inflation and characterized supply chain disruptions and explains that they mainly drove inflation in 2021, and then there is a combination of demand and supply for 2022. And there are several contributions I also listed four, among the many that are in all in this paper. The first one is to provide an index of supply chain disruption. It's actually a congestion index. Then there is a model that is used to have a theoretical framework for thinking about supply chain, and then it's used as a device for the empirical implementation to draw identification restrictions in the empirical framework. And then finally, there are policy prescription in terms of what monetary policy could do in this context. What I'll do is that I'll focus first in terms of a little bit of background on inflation and supply chain disruptions. I will then offer a couple of remarks on the congestion index and also on the model. And I want to defend a little bit the work we did at the New York Fed during my time there, where we constructed this index in 2021. It was a product that we developed following, of course, the demand that were coming from the economic outlook in terms of inflation. We developed it at the end of 2021. It was a report that we prepared in a relatively short time period. It was in a month. We didn't have access to data like this granular high-frequency data. And one of the issues, of course, was that there were a lot of talking about supply chain disruptions. And when you look at different reports, these reports were using Harper index. They were looking at the Baltic dry index, then delivery component of PMI. And what we thought was all these actually provide different information. So the approach we took was to combine information. And that's what is the Global Supply Chain Pressure Index about, to put all this information together, believing, of course, that there are limitations in some of these components. There are, imprecisions and so on. What we did was to, importantly, and it's something that actually I want to stress, to isolate the supply component coming from all these different indicators. How did we do that? We did by a simple regression analysis in which we use proxy for demand on this indicator to isolate the supply component and put it in a principal component. So that's what we do. Yes, unfortunately, this is not what is coming out from, it's not acknowledged, I have to say, in your work, despite, I think, in fact, also that some of my co-authors on that paper did discuss your work earlier. Now, there is another index that we also developed, and we have several blogs on this in which we look at the role of China, we do scenario analysis, we look at the impact of war in Ukraine, and there is a lot of information that you can use from this index, actually. And let me give you a little bit of a perspective on this. Now, the blue line is actually our original index, and the red line is the index in which we do not isolate the demand component. What is interesting here is that there were supply disruptions in the first part of the pandemic. That's what the blue line is telling us. But the net index, the red one, is actually on historical average. What it means that those lines that you see below there is actually the demand. It's global demand that is depressed, and that was happening in the beginning of the pandemic. Later on, we saw this picking up, and what is picking up is not demand, it's supply problems. That's what you see, because these two lines co-move. And then you see how they go down, and actually, again, we can isolate this demand component. It's the global demand component. We also developed regional indexes that if you can ask people, and my ex-colleague at the Fed, they will give it to you. And you can play with them. Actually, they can give you even more information in terms of, fortunately, not everything is public available, but that's what we did. Now, so, of course, how did we use it? We use it for trying to understand inflation. And we did it in a very simple way, not structural. There's no identification. These are correlates of inflation, PC. This is the goods inflation, and PPI inflation. And the last part is the out-of-sample properties of our simple model. And it's actually tracked relatively well. And we use it, indeed, for scenario analysis to understand what would happen if this supply chain index would drop to 0. And in the latest blog that we published last year, we indeed show that inflation would go towards 3% when this index would go to 0. So there is a residual that comes from other forces, mainly in the US. Now, what is this index that they construct? I think it's very interesting. Actually, during my last period at the Fed, we wanted to incorporate this data that Francesco and his co-author used, and that's actually very much used in the literature on shipping. And there are a lot of congestion indexes, if you dig in there, that are provided by several intelligence companies that monitor shippers at high frequency. And we actually had the data. We bought the data, data that goes back to 2030 for other purposes, and we hopefully use it at some point. Now, I think it's great to use this data. It is fascinating once you start reading about what's happening there. And some of these companies monitor everything about the ships. They know everything, okay? Now, there are, I think, still issues. There are always issues when you construct these indicators. I don't think, as this paper is suggesting, this is just a pure measure of supply. It's not, for various reasons. Because even in a bus, there are a lot of people sometimes, and sometimes there are less people. These cargos sometimes are full, sometimes are not full. And you need to use other proxies to try to capture supply. For example, there is cargo miles that you can use. There is cargo quantity that you can use. And some of these companies provide these measures because, as I said, they know everything, even the name of the captain and what they eat. Now, there is other claims that are made in the paper. Personal restriction did not cause port delays. But yes, of course, these people were exempted, but sometimes they cannot go to work if they got COVID. So there is a problem there too. And port delays also can be affected by several factors that can be looked and measured in terms of demand. So still, I think it's great to use this data, and I think we should use this data. But the way I think about this data is not as something that you should, as I said before, are complementary. This is other information that you want to bring in the picture. I don't think you should use something in this way. Also, to be open here, you criticize also the Harper index, which is a transportation cost proxy. And in the model, you have the transportation cost as a proxy for supply chain, which is another issue. Now, there are a lot of these. OECD is also using this data. This is for the Department of Transportation. They have a similar proxy of congestion. You can see it for all the US. They don't develop this machine learning algorithm to purify the data, but as you can see, the trajectory for the blue line, which is total US delays, is pretty much similar to the one that you construct. Now, as you can see, as I said before, there are this index here. On the left side, I have our index proxy and tracks relatively well. This is just a visual analysis. And in your index is relatively flatter, relatively to the behavior of goods inflation. The model is is interesting itself. It's a newer model. It's based on search and matching friction. And as I said, use transportation costs as a proxy. But I think, one of the reasons we use this model is to try to capture this gap in terms of productive capacity and scarcity of goods available to retailers. But when we think about supply chain, of course, it's important to think in terms of input-output structure. I think that's what is the core of supply chain mechanism. And this is important also for the propagation of shocks. And your model, in this sense, is also limited from a dynamic point of view. And another thing is that the proxy for spare capacity is unemployment. But this unemployment, if you look at it for the US, moves basically in opposite direction relative to the supply chain. Now, in your model, when you impose the restriction in the empirical model, of course, you will find movements that goes in your direction. But if you look at simply descriptive data, you will see the opposite going on. So, of course, there's policy playing a role. There are other things playing a role. So it's difficult always to identify everything. I provide in my slides a very simple model based on a new Keynesian framework in which you can capture all this. It's a model that is inspired by the work of Comín. I think it's a very good framework for thinking about this. What is interesting about the model that I like is the fact that there is a nonlinearity associated with the possibility that you have a capacity constraint. Here I solve it in a simple two-period framework, and you can see that you have that vertical line that is the full capacity. Then you might shift in, and that's when you have a supply chain disruption. It's also there you can have these measures of gaps that they do have in their paper. There are interesting implications, of course, of this disruption for the natural rates of interest. I go fast on this because I'm over time. And I want to conclude a little bit. I think it's important to use granular data. I think this paper brings this data into the literature, and in this sense is important. I think it's important to use them in a complementary way. And I think that is something that would be welcome to develop further. I think there are a lot of differences between the model and the supply chain characterization. So there I see a little bit of a gap in terms of what you want to achieve. I believe that it's much better to always think in simple terms, both in terms of the empirical analysis and also in terms of the model. The model is simple maybe, but it's, I didn't find it so simple. I think also there is an interesting report that Silvana is here. It's very good, in my opinion, in terms of characterizing the issues surrounding the supply chain and the policy implication, and in general supply shocks. And it's interesting also because it emphasizes the importance of looking at dynamic aspect and the propagation between one sector and another sector, and they exploit this in a if I'm not mistaken, two-sector model. And what you see later in service is the byproduct of what happened before in goods and differences and asymmetries in price adjustment. And I think that is important. That also, they discussed it, probably Silvana will say something in terms of what are the policy implications that comes from this model. So I think that this is a key report for me, and I think it's very interesting to read. I suggest you also to have a look at that. Thank you very much.
We welcome now questions from the audience.
Paul Baudry, Vancouver School of Economics. So thank you very much. Very nice presentation. So I guess I had two questions. First, I haven't read the paper. Had trouble understanding how you're identifying those shocks. Is it sign restrictions, then it's imposing the aspect that you're getting here, or are you using this as an instrument? And then if you're using it as an instrument, then the other complaint of whether it's really a kind of just a supply shock or if it's kind of this combination. Again, here, I kind of felt the same thing even before the comments was you're kind of wanting to sell this as just this pure supply shock, but it really happened at a very particular time. It was like this demand for goods. It's not like, all of a sudden there was no goods coming in. It was there's so much demand for goods. There's tons of goods coming in, but not as much as the demand. So I didn't kind of get that part. Last question is just on the policy front. When you think about raising interest rates, so I understand completely if you have sectors that are kind of constrained, you're kind of thinking, well, you can reduce demand and you're not going to reduce the output because they're actually constrained, and kind of that's working. At the same time, a lot of interest rate changes kind of affect like the construction sector and housing and all this that are non-tradable. And so maybe the effects that you're saying is a little bit mitigated how much you're thinking the policy is kind of directly related to the demand in that particular sector.
Silvana Tanreiro, London School of Economics. Very nice paper, Francesco. I guess I had two questions. One, looking at the impulse response functions, the real GDP response is very short-lived, so a couple of quarters, and then you have an expansion on GDP. So if you think about monetary policy and the lags in monetary policy, if you wanted to offset that, that would be very, very hard. You need to, increase rates by a lot and then decrease by a lot in a space of a couple of quarters. So I don't think that seems very realistic, and then that adds to the point that Paul was making, that you affect a lot of other sectors in the economy, so it's hard to draw a clear conclusion from that. The other thing is just a clarification. I wasn't sure I understood the model. I mean, what's the search friction here? Yep, that's it.
Joe Gagnon, Peterson Institute. It's a question for both the author and the discussant. And I haven't read the paper, so I haven't seen your references, but there's a paper by Phil Levy. I don't know if you're aware of it. He was a chief economist at Flexport, which is a big port management company. And he has a paper about a year ago, and he says something quite different from what both of you say, that during the 2021-2022 period, it's sort of what Paul just said, yes, we had port congestion because throughput was the highest ever recorded, and demand was so strong that we've never had so many imports flooding into the US during this period. And it seems at odds with what you were saying about how there's sort of port congestion is evidence of some exogenous reduction in the port capacity, whereas he was saying, no, in fact, ports have never been used so much. And it even seems a little at odds with, Gianluca, your graph, where the GSCPI demand measure during that period is not doing that much. And he says they were off the charts. So I'm just curious if you have looked at that paper or have any comment on his claims.
Dario Caldara, Federal Reserve. One question also related to the model and then to the identification is whether you think about, in your trade, you differentiate between trading intermediates and trading final goods, and how that then would go in terms of, again, feeding into spare capacity or, your output inflation co-movement. Thank you.
Can I ask you a question? Yeah. Okay. Just, I'm going to iterate this, common question of how do you, clean the demand? I mean, early on, the first thing was the masks. I mean, everybody wanted masks, and Chinese ships stuck at the LA port because they were bringing so many masks. And in fact, the index Gianluca is using, I thought you guys cleaned all the demand measures like back orders, backlogs, PMI, and all that. And in our earlier work, the one we did in 2021 to get at the supply chain, we use the index Gianluca used, and we kind of look how well it moves with those type of, kind of demand-based orders to really get out that part, that demand part. That might be useful.
Thank you. Thank you, Gianluca, for the comments, and thank you for all these comments. So let me give a broad answers. Some of the comments can be clustered together. So About the indexes, so what we claim is not that we have the best index. We claim that we have a very special index that, in a way, it's more immune than other indexes to the pressures of demand and supply, because this index does not reflect the fact that the boats, they adjust the route or they adjust the way in which they transport goods around the world, because there are more demand or supply pressure. So that is the claim that we make, that we don't do any like cleaning of the data. And instead what we felt is that some other indexes, so here I admit that I wasn't aware that you have an index that cleans, that identifies the supply, and then through the comparison you can do that. We'll make justice to that, so we will describe better what you do. But we have an index that is different. It is immune to that, and part of the paper is not written saying, oh, look, we are dominating here in terms of indexes. It's to show what our index, what are the consequences when you do identification. What are the consequences, what they call supply chains compared to us. So we are not really in the game of on criticizing. Regarding the model, so it's true, we could have had an input-output model, a dynamic model, much more complex. Why do we have, we want to have a search and matching model? Because in search and matching model, prices are not allocative. That's what happened during the pandemic. You want a Ferrari. You say, I'm going to pay 2 million. The Ferrari is not going to arrive to your doorstep because there is a supply chain. And so that is the idea of having search and matching frictions that are between retailers and the suppliers, the producers. And there is where you build these frictions so that you can have that the producers, they are down in China, they've done the work, the pieces are there, but they cannot deliver it. And there is a lot of spare capacity, but still that translates in upward pressures for the retailers. And so now you have that the demand there is there. The supply is contained, so prices move a lot, but output doesn't change. And that is the essence on then how monetary policy, by depressing demand, has a different effect on prices and output than in times where instead those goods can be delivered. Then regarding the sign restriction, so the response of the real interest rate. So there, for the responses, we don't want to make too much claim because we do identification through sign restriction, so we don't use as an instrument. And there we need to be careful because also the estimates are somewhat imprecise. The sample period is small, the error bands are large. So there we don't put too much emphasis in interpreting. We just say, look, symptomatic of a supply chains are this stagflation with an increase in spare capacity. For us, that is what we felt we can squeeze out of that identification in the VAR. And search frictions in the model between retailers and producers. This is just a device to have that prices, the tightness increases prices a lot, whereas there is abundance of goods, despite prices goes up for the retailers. Regarding this, your point about, I wasn't aware of it. So if you can give me the reference, I don't know if you want to comment, Gianluca.
Well, I don't know the paper, but one thing that, in terms of what I've shown there that is important is the fact that what we are capturing is a global demand. So we might actually need to look at, for example, US component, and might be different. And there is a problem when we are looking at some of this stuff from a more regional point of view, is that the data set we use is limited, so the number of series drops. So in the original GSCPI is 27. When we look at the regional ones, we have shorter number of series. So what we had was a little bit more volatile, and actually that's why, one of the reasons why we actually had this data go back to 2013 to integrate and get a little bit more smoothness in that to do this type of analysis you suggest. So there might be this, and what I show is global, it's not US specific.
And then, final question, Dario, did we use trade and trade data? Not really. So here it's something that we can do. We can chat more, you can tell me if there is anything in particular we should look at. Here we use standard macro data because this is a macro paper. It's not about input output. It's not about networks. It's more about the global happening, the supply chains, and so that's why we use the macro model. The next step is to do the input output. I know that some of you are doing it, and I think it's great. That's it. Thank you.
So thank you, and yeah. We will have lunch now, and we will resume at 2 p.m.
Okay, welcome back for the afternoon session. My name is Oreste Tristani from the European Central Bank. So we start from breaks in the Phillips curve, evidence from panel data. Simon will present, and Giulia Gitti will discuss. Simon, the floor is yours, so 25 minutes again, and I think we have the...
Okay. All right, can everyone hear me okay? Okay, perfect. Yeah, so today I'm going to be talking about the Phillips curve, time variation in the Phillips curve. And this is joint work with Alan Timmerman at UC San Diego and Jonathan Wright at Johns Hopkins. So thanks a lot for including the paper on the program. And the usual disclaimer applies, but let's get straight into it. So starting with a quote from Chair Powell, basically suggesting that there was a tight relation between inflation and unemployment, going back several decades, but that time is long gone. So, this idea that there's this Phillips curve relationship, but it appears to have flattened over time. And so this is something that we're going to be exploring in this paper. So there's a well-known relation here, it goes all the way back to the 50s, the original analysis by Phillips, which was on the wage Phillips curve. And obviously, the Phillips curve is a key element in the new Keynesian macro model. I won't spend too long motivating this for this particular audience, but there's mounting evidence that the Phillips curve is not stable, but in fact varies through time, and a particular emphasis in the literature on a flattening in the Phillips curve over the most recent decades. So this has clear policy implications for the ability of the central bank to control inflation. If the Phillips curve is very flat, then that could be problematic. There's a very large literature on the Phillips curve, and there's many, many papers that have looked into time variation in the Phillips curve. Here's just a very small subset of them, and I'm not going to go through them individually, but just to point out that the majority of the papers either do subsample splits, where they assume the dates at which they do the split a priori, which is fine as long as you get the dates right, but it's problematic if not. Or they tend to use rolling windows, which can also be problematic because you don't know the length of the rolling window, and it's typically assumed to be fixed through time. Another thing to point out is that most of the literature has focused on estimating Phillips curves using national aggregate data, so just a single time series at the national level. There's a more recent literature that looks at using disaggregate data, so regional or sectoral level information, and that's the approach that we're going to take in this paper. And we'll argue that it has several key advantages instead of just looking at the national data. One of the key things is the endogeneity problem in the national Phillips curve. So if the central bank is successful in targeting inflation, then previous studies have pointed out that that will create a downward bias in the slope of the Phillips curve towards zero. One way to get around this problem is to use disaggregate data and include time-fixed effects. So use regional level data or sectoral level data and include time-fixed effects to absorb the shifting monetary policy regime through time. And also because, of course, the central bank is not targeting inflation in one particular region or one particular sector, you don't have the same issue that you have when you look at the national level data. Cross-sectional information can be useful to help you identify sources of instability in Phillips curves. As I just mentioned, it helps you circumvent the endogeneity problem using the national data. And it can also reveal cross-sectional heterogeneity in the Phillips curves as different regions or sectors can follow different business cycles, and you get richer heterogeneity in the data when you exploit information in the cross-section. That's from the economic perspective, and then from the econometric or statistical perspective. Here we're going to be looking at Phillips curves and estimating these models with structural breaks to allow for regime changes. The idea being that there's a shift and then the slope of the Phillips curve becomes flatter in the post-break regime. Just using national aggregate level data, these time series breakpoint procedures tend to have relatively low power, and they can have difficulty pinning down breaks, especially if they occur near the end of samples. And we develop a methodology in a separate paper, which is applied in this paper, which shows that exploiting information in the cross-section, your panel break approach has a lot more power to detect breaks relative to the time series approach. We're going to make assumptions of commonality of timing and impact of breaks here. We do relax this in the paper, where we allow the timing of breaks to vary in the cross-section. But given the time constraints, I'm just going to talk about the baseline models today where you assume a common break date in the cross-section. There are different stories out there for what drives the flattening of the Phillips curve. And in this paper, we're not going to make any strong claims of causality of what's driving the flattening. We're going to estimate the flattening, and we'll have some results which would be consistent with the first story here, which is greater openness to trade and import penetration basically driving the flattening of the Phillips curve. And there are recent papers that have looked at this and how increased openness to trade can cause the Phillips curve to get flatter over time. There are other stories out there like declining rates of unionization that can drive this, or things like inflation being stable at a low level for the 3 decades before the pandemic, which meant there was not much need for economic agents to pay attention to inflation for things like wage bargaining, for example. So in terms of the data, we're going to exploit different data sets in this paper. So first of all, focusing on the US, we're going to first look at sectoral level data. And so here we'll look at PCE price indexes, where we'll have the 16 industries that Stock and Watson look at in their paper. And this is quarterly data that goes back to the 1950s. We'll also look at CPI, so-called CPI level 3, which is a breakdown of 31 different industries in terms of the disaggregation. This is again quarterly data which goes back to the 50s. We'll also estimate a wage Phillips curve, and so here we'll use average hourly earnings for the different states in the US. This is quarterly data that goes back to 1980. And then we'll use some regional level data, so we'll use MSA level data within the US. And so this is going to be CPI, headline CPI inflation for 22 MSAs, clusters of cities. And this will be annual data that goes back to 1980. Then we'll look outside the US and we'll estimate a country level Phillips curve for the EU. And so here we'll use the 28 countries in the EU. We're including the UK, which was part of the EU for the majority of our sample. And this will be annual data going back to 1986. So in terms of the model, we're going to have a Phillips curve framework, and we're going to allow shifts in the slope coefficient of the Phillips curve to change an unknown number of times, which we're going to estimate. So there are K breaks, and we estimate K, and these K breaks occur at unknown locations, which we're also estimating, which will be the taus. We're going to assume that breaks are common, so they hit all series in the cross-section at the same date, at least what I'm going to present to you today. And so this will be identifying breaks that are truly common across regions or across sectors. And so the model will look something like this. So we'll have, for the K+1 regimes, which are separated by the K breaks, the MSA level model will include two-way fixed effects, and then it will have a persistence component, and then it will have contemporaneous unemployment rate on the right-hand side. So the first thing to note is we don't have a clean estimate of the natural rate at the MSA level, so we're not using the unemployment rate gap, we're just using the unemployment rate. But we do have the MSA level fixed effects, which should be absorbing some of these differences across MSAs that are constant over time. We have time fixed effects, which should be able to absorb changing monetary policy regimes, for instance, over the course of the sample. And in results that I won't show you today, if we used a lagged unemployment rate, for instance, the results are broadly similar to when we used a contemporaneous measure. We're going to apply the exact same model to the EU country-level data, but there we're going to use the unemployment rate gap instead of the unemployment rate, because we have the natural rate estimates for each of the countries. So this is going to be a Bayesian panel break approach. And so we need to specify some priors. So first of all, we'll specify a Poisson prior, which is standard in the literature, where we will be assuming that breaks occur on average every 20 years. We allow breaks or regimes to be shorter and longer lived, but on average in the prior, we're assuming that breaks occur every 20 years. The priors over the regression coefficients, so the Phillips curve slope coefficient, are just standard normal inverse gamma priors, and we specify these to be relatively uninformative. And I won't talk about it today, but we have a lot of robustness checks which show that all our baseline results are very robust to changing these choices of priors. In terms of the estimation, so we'll estimate this using a MCMC algorithm, which is developed in a separate paper. And this algorithm essentially will loop through many iterations, trying to randomly select different breakpoints. And it will gradually move towards the favored number and timing of breakpoints as you loop over and over this MCMC algorithm. So in terms of the empirical results, if we start with the sectoral level results within the US using the 16 PCE price indexes, so the first three columns here are from the breakpoint model. So we find evidence of 2 breaks, which separate the 3 regimes. And so the first break occurs in the early 70s, and the second break occurs around the turn of the century. And when we're using all industries, so all 16 PCE components, we find a steepening after the break in the early 70s, where the Phillips curve goes from about minus 0.5 to minus 0.8, and then a subsequent flattening around the turn of the century. Okay, so we find evidence of 2 breaks, a steepening and then a flattening. The final column is presenting the results when you preclude breaks. So you just estimate on the full sample and don't allow for breaks. There, you essentially smooth through the 3 regimes, and so that conceals this evidence of this steepening and flattening that we identify within the Phillips curve. We next exclude food and energy sectors and re-estimate this approach, and we find the same basic pattern of the 2 breaks and the steepening and subsequent flattening, but the magnitude of the Phillips curve is a bit flatter everywhere in each regime when we exclude food and energy sectors. We then break this out into goods and services, and so we just estimate a goods Phillips curve separately using only those industries, and then a services Phillips curve using only the services components. And here we find, again, the steepening and then the flattening, but the steepening in the second regime you can see for goods is much more pronounced than it is for services. And then the flattening in the final regime, the services Phillips curve still seems to be active in the final regime, whereas the goods Phillips curve is not significantly different from 0. Turning to the MSA results, so here we had 22 different MSAs, annual data going back to 1980. Here we find evidence of 1 break around the turn of the century. So we can't find the earlier break that we did in the sectors in the early 70s because our data don't go that far back, but we still find the break around the turn of the century with a flattening in the Phillips curve, But here we find that the flattening is less pronounced than we found in the sectoral level data. Next, we turn to breaking these MSAs out into two groups, and we form these two groups based on those which have above and those which have below the median rate of import penetration from China. And this is taken from a paper from the BLS, which estimates rates of import penetration from China for each state. And so we allocate our MSAs to the corresponding states. And for those MSAs which cover multiple states, we assign them to the state for which the majority of their population is based. And then you can see those that have lower rates of import penetration, you don't really see as much evidence of a flattening across the two regimes as you do for those that have above median rates. And so this would be consistent with this idea of greater openness to trade, which could be one of the factors that is driving the flattening of the Phillips curve over time. Next, we look at nonlinearities in the Phillips curve. So the idea that the Phillips curve might be relatively flat, but could become a lot steeper in very tight labor markets. And one of the advantages of using disaggregate level data here is that you have many more observations of a very tight labor market. So an unemployment rate below 5 or 4% when you look at the MSA data. When you just look in the national data, you just don't have that much variation in the data. You don't have that many observations when the labor market has been very tight. And so using this MSA level data is likely to be helpful here. So what we do now is we estimate a Phillips curve within these two regimes, but we allow for a kink in the Phillips curve at a threshold of 5% unemployment rate. So the idea is you may have a certain steepness in your Phillips curve in a regular labor market, which is defined as unemployment rates above 5%, but when you enter a tight labor market, i.e. the unemployment rate falls below 5%, the Phillips curve coefficient can get steeper because there's a kink in it. And so in the first regime, we find that in a regular labor market, the Phillips curve is minus 0.26, but when you fall into a very tight labor market, that nearly doubles. And so the Phillips curve coefficient becomes minus 0.48 when the unemployment rate is below 5%. In the most recent regime, we find that in a regular labor market, the Phillips curve is flatter, generally, minus 0.18. But then the kink is even stronger in a tight labor market. And so when the unemployment rate falls below 5%, you still have a very steep Phillips curve of minus 0.46. And when you ignore the breaks and you just estimate this using all the data, that's the final column, you find that you underestimate the extent of the kink. So the extra kink you get is just minus 0.19, which is underestimating the kink you get when you just focus on the most recent 20 years of data. And so this has important policy implications, especially for the tight labor market, the trade-off between unemployment and inflation, and the benefits of running monetary policy when you have a dual mandate. You know, you've run the labor market hot up to about 5%. The trade-off with inflation is going to be lower, but once you go beyond 5%, the trade-off with inflation is going to be much more costly. Turning to a wage Phillips curve using average hourly earnings across states within the US, we find evidence of one break, again around the turn of the century. Here we find a flattening in this wage Phillips curve, but to a lesser extent than we found in the sectoral level price Phillips curves. And so this is consistent with some earlier literature which finds that there's been more of a flattening in the price Phillips curve, but less so in the wage Phillips curve. Again, we run the nonlinear approach where we allow for a kink at 5%. And again, we find evidence that there's a clear, significant nonlinearity here where the wage Phillips curve becomes a lot steeper when you enter a tight labor market. Turning to the EU, we find evidence of one break in the early 2000s, and the Phillips curve goes from being quite steep, minus 0.8, to relatively flat, minus 0.14 in the final regime. Breaking it out into goods and services, again, we find a stronger evidence of flattening in the goods Phillips curve than we do for services. Services, we find just a small amount of flattening across the two regimes. Again, we find evidence of a kink in this Phillips curve, and here we find that in the pre-2004 regime, the Phillips curve was reasonably steep in regular labor markets, but did not become steeper in tight labor markets, but that now there's been a clear flattening in a regular labor market, but it becomes a lot steeper. There's a very significant nonlinearity when you enter a tight labor market, which we define as an unemployment rate gap that is tighter than minus 1.5%. And we take this threshold from a paper by Stock and Watson. So in terms of aggregate implications, we run the same exercise that Nakamura and Steinson run in their paper. And so the left-hand panel is focusing on the US, and the red line is headline CPI inflation minus 10-year ahead CPI expectations taken from SPF. The solid black line is what is implied from our linear Phillips curve, estimated on MSA level data, but not allowing for any kinks or nonlinearities in a tight labor market. And so first thing we want to say is we don't find any evidence of missing disinflation around the Great Recession, which would show up as the solid black line running below the red line around the Great Recession period. We also don't find any evidence of a subsequent missing reinflation in the post-financial crisis recovery period. And that would show up as the solid black line running above the red line. So these results are in line with what Nakamura and Steinson find, and it comes from the Phillips curve slope being relatively flat. The next thing we look at is the pandemic period. Okay, so can we explain some of the surge in inflation that we've seen during the pandemic period? And so now we focus on the dotted black line, and that comes out of our nonlinear estimation, which allows for this kink when you enter a tight labor market, and combines this with estimates of the natural rate during the COVID periods from a paper from Crump and co-authors at the New York Fed. And this finds that you can explain about 40% of the surge in inflation during the pandemic. And our model doesn't include things like energy price shocks or import price shocks. And so if we were to account for things like that, you may be able to explain even more of this run-up in inflation. The panel on the right does the exact same exercise, but for the EU. And here, because we find that the Phillips curve is very flat, there's clearly no evidence of any missing disinflation around the Great Recession or missing reinflation in the subsequent recovery period. So to conclude, we find evidence of up to 2 breaks in the price-Phillips curve, one in the early 70s, after which the slope steepens, and another around the turn of the century, after which the slope flattens. The steepening we find is largest for food and energy sectors, but the flattening is broad-based across different sectors, but we find that it's greater for goods than it is for services. And this could be consistent with the idea of openness to trade, where we might expect services to be more sheltered from the effects of globalization relative to goods. We also find that the wage Phillips curve has flattened, but to a lesser extent than the price Phillips curve. And finally, we argue that using disaggregate panel data is helpful, especially if you want to identify nonlinearities in the Phillips curve, because you have more observations of the labor market being very tight in the regional data relative to the national data. And we find that ignoring breaks causes the steepening or the kink in the Phillips curve when you enter a very tight labor market to be underestimated. Thank you.
Good afternoon. It is a pleasure to be here, and thank you to the organizers for inviting me to discuss this very interesting paper. So overall, I really enjoyed reading this paper, and I learned a lot from it. In my research, I have estimated both a Phillips curve with a time-varying slope and a nonlinear Phillips curve. So I particularly enjoyed learning how the authors have thought about these two features and their interaction. So as all of you know, the relationship between inflation and economic slack has changed dramatically over the past several decades. And this paper revisits the empirical evidence on changes in the slope of the Phillips curve by using a novel estimation method, a Bayesian panel break approach, which exploits the extra information provided by panel data in order to better identify the slope of the Phillips curve and the regime changes. And it allows for more flexibility because it is able to detect multiple breaks and allows the Phillips curve to differ across groups of observations. There are three main results of this paper. The first one is that the sectoral Phillips curve in the US steepened in 1972 and flattened in 2001. The second one is that the country Phillips curve in the EU flattened in 2004, and there is also evidence of convergence of the Phillips curve between rich and poor countries. And third, the metropolitan area Phillips curve in the US is steeper at low levels of tightness, and this nonlinearity is time varying because it is more pronounced in the regime after the year 2000. So in order to discuss this paper's contribution, let me first start with explaining how this paper is placed, in my view, in the Phillips curve literature. So the literature has rationalized the changes in the relationship between inflation and economic slack in two main ways. The first hypothesis is that the Phillips curve has a time-varying slope. And there is a lot of empirical evidence on this, while the theoretical work needs to catch up a little bit. Up to now, the literature has found globalization and changes in the network structure of production as structural forces underlying the change in the sensitivity of inflation to economic slack. The second hypothesis is that the Phillips curve is nonlinear. Again, there is empirical evidence of this, both at the regional and aggregate level. And the theory has explored several mechanisms driving the nonlinearity. Examples of these mechanisms are a quasi-kinked demand for goods, a nonlinear wage Phillips curve, or the existence of capacity constraints. So this paper offers empirical evidence of both structural breaks, nonlinearity, and their interaction. So I think it also shows a new path for future research, because if this is the case, then we need a theory that combines these two features. So the first contribution of this paper is to provide empirical evidence on both a time-varying slope and a time-varying nonlinearity of the Phillips curve, while the second contribution is methodological, because this is the first paper to formally consider in panel data estimation multiple breaks and partial pooling of the estimated slope coefficients. Now let me turn to my feedbacks. I have three main comments. The first one is about supply shocks and endogeneity. The second is about labor market conditions. And the third one concerns inflation expectations. So first of all, the identification of the slope of the Phillips curve is a very challenging task. There are, for many reasons. One is, as Simon was saying, the endogeneity driven by monetary policy, but another reason is the existence of the simultaneity bias between demand and supply. And this is driven by the fact that the unemployment rate or the unemployment gap is an equilibrium object, so it is driven by both demand and supply shocks. Demand shocks decrease unemployment and increase inflation, while supply shocks increase both unemployment and inflation. So failing to control for supply shocks induces a downward bias in the slope of the Phillips curve, and I wonder how these affects also the detection of structural breaks. So for what concerns the sectoral Phillips curve, the authors check the robustness of the results to the use of core inflation instead of headline inflation. And this is a simple way of removing some cost push shocks that might affect headline inflation because core inflation, of course, eliminates food and energy prices. However, I think it might be important to control for other, to add controls for aggregate supply shocks, especially in the specification with headline inflation, for example, changes in the oil price, in the relative price of import or labor productivity. For what concerns the regional Phillips curves, time-fixed effects effectively capture aggregate supply, everything that goes on at the aggregate level, including aggregate supply shocks. However, in one of my papers, I find that dealing with the regional supply shocks is crucial in estimating the post-COVID steepening in the Phillips curve. So I think it might be important to add controls for regional supply shocks, for example, the relative intermediate input prices or the difference between local headline and core inflation. About my second comment, so in the literature, the unemployment rate and when available, the unemployment gap are the most commonly variables used to measure economic slack. But there are some recent papers that have highlighted the relevance of labor market tightness instead of the unemployment rate to inflation dynamics. So labor market tightness is defined as the number of job vacancies per unemployed workers, where job vacancies capture the state of labor demand and the number of unemployed workers track the state of labor supply. So for example, Barnishan and Shapiro, they have shown that labor market tightness outperforms the unemployment rate in the forecast of both price and wage inflation. While in my job market paper and in the paper of Goetti and Pierpaolo, we have estimated that there are significant non-linearities in the Phillips curve with respect to labor market tightness. So I would be curious to see whether, what results the authors would find if they were to use labor market tightness instead of the unemployment rate as a measure of supply shock, of economic slack. One challenge of using labor market tightness is that vacancy data is not as readily available as the unemployment data, but here I have listed some source of data that you could check at the three levels of disaggregation that the authors consider for the US. My third and last comment is about inflation expectations, because Mavroidis and co-authors have shown that the estimates of the Phillips curve are highly sensitive to the measure of inflation expectations used in the regression. And so I think it would be important to check whether the results are robust to different measures of inflation expectations. When estimating the sectoral Phillips curve, the authors use as the inflation expectations measured the data coming from the blue chip economic indicators and Livingston, which capture inflation expectations of professional forecasters. But the literature has shown that also consumers' inflation expectations are important in the estimation of the slope of the Phillips curve. So for example, Dozer and co-authors have, they construct an inflation measure using data coming from the University of Michigan Survey of Consumers and the Survey of Professional Forecasters, and this data is available since the 1960s, so this could be used. And while when estimating the Phillips curve with regional data, time-fixed effects, one of the advantages that time-fixed effects capture the long-run inflation expectations, because these long-run inflation expectations depend on the monetary policy regime in place, which is common across regions. However, short-run inflation expectations could differ across regions, and so you could, for example, add as a proxy for inflation expectations, such as the gasoline, inflation in gasoline price. So to conclude, I really enjoyed this paper. I appreciated especially the fact that the methodological innovations developed by the authors provide a better identification of the slope of the Phillips curve and allow the data to speak more freely as they endogenize the number and time of breaks, and they allow the slope of the Phillips curve to be different across groups of observations. And I believe that the results that they find have important policy implications for monetary policy and future research, especially the one about time-varying slope and time-varying nonlinearity. Thank you.
Okay, let's collect a few questions as usual before giving Simon the chance to rejoin.
Hi, Amy Hanlon, Brown University. I was wondering if you could speak a little bit to how you conceptually differentiate between having a nonlinear Phillips curve and just moving along that nonlinear Phillips curve at different points in time versus having true breaks in the nonlinear function.
I guess very related. I wasn't sure how you distinguish between the slope and shifts in the curve because of, oil price shocks or something else that.
Very nice stuff. I'm just curious, what would you miss if you did, like, suppose I just wanted to do like a silly Andrews test on like an aggregate Phillips curve for structural breaks. Would I miss any of those 3 breaks, or so what would be the, I'd like to know more because it sounds like the methodological innovation is key here. So maybe it would be nice to kind of say what you'd miss if you use some standard sort of technique.
Sylvain?
Yeah, Sylvain Leduc, San Francisco Fed. So some of the work I'd done with Dan Wilson in San Francisco on this, what we were finding was that a lot of the slope was driven by rent inflation. So at the MSA level or at the state level data. Absent that, the slope was either insignificant or very, very small.
Mark?
Mark Ertler, NYU. Very interesting paper. I had a question about interpreting the recent data in terms of a nonlinear Phillips curve. If you look between 2021, middle of the year, to beginning of 2022, you see unemployment going down as the economy recovers, and you see inflation going up, okay? So it looks like there's a strong effect of unemployment and inflation. But then unemployment has been roughly stable since the beginning of 2022, and inflation has come down. So how can you tell the difference between a nonlinear Phillips curve versus supply shocks happening at the same time? That is, supply shocks are ramping up over 2022, then supply shocks are easing.
Okay. All right, well, that was many questions, so I'll try to remember them and respond to as many as I can. So thank you very much, Julia, for the discussion. So yeah, I agree with all of the points. So comment number 1 was about supply shocks. And so, as you pointed out, one thing we do, which is similar to what Silvana Temrero does in her paper, is to look at cutting out essentially food and energy and just focusing on the core industries. And that will get rid of at least a decent subset of the supply shocks, but not all of them. And so we do that at the sectoral level, and we find the basic same idea of the 2 breaks, the steepening and then the flattening, when we cut out the food and energy sectors. But of course, the magnitude we find in each of the regimes is flatter. So that's one thing. Adding aggregate controls is a good idea, so we could certainly put in things like oil prices, relative import prices, and this could also be interesting for the exercise we do around the pandemic, because the oil price likely played a big role there in explaining some of the run-up in inflation. So I think that's a great idea. For the regional Phillips curve, so we have the time-fixed effects, which are capturing the aggregate supply shocks, but then there is this problem of potential regional level supply shocks, right? And so, we could account for regional level controls. I think that's the next logical step in this paper, as you do, in your paper. So, coming up with a shift share instrument like Nakamura-Steinson type idea, and then rerunning this when you control for that. So I think that is something that we will consider in the next iteration of the paper. Measures of economic slack, or alternatives to the unemployment rate, and so this is at least partly related to your comment. So, there's a lot of emphasis now on not just looking at the unemployment rate or the unemployment rate gap, and instead focusing on, say, the VU ratio. We haven't considered that in this paper, so luckily Governor Waller's not here, because he'd probably kill me for not considering the VU ratio. But I think that's natural, and Julia has a really nice paper which looks at this in the, looking across regions and using an alternative measure of labor market tightness with the VU ratio. And that's very relevant, I think, for the pandemic period because, as we were just mentioning, the unemployment rate has not moved that much, and inflation, went up and came down. And so one thing could be that there's, supply shocks that are driving the run-up in goods inflation and then the subsequent disinflation. But also another aspect to that could be looking at alternative measures of labor market tightness, like the VU ratio or the job workers gap. And so we've seen the VU ratio moved up to about 2 and has since come down to about 1.4. And so there's been easing in the labor market when you look at these alternative measures of tightness, but not much movement in the unemployment rate itself. So, yeah, I think looking at alternative measures of labor market tightness, and so, for instance, trying out one of these regional, MSA level models with the VU ratio on the right-hand side and then running our breakpoint approach would be a natural extension, a next step that we could look at. And then the third comment was robustness to inflation expectations. So we focus on the blue chip. So 1 year ahead CPI, headline CPI from SPF, and also from the Livingston survey, but there are alternative measures of inflation expectations. So we could look at, the Michigan survey, we could look at, SPF and so on. So I think this is a valid comment. We haven't considered this so far in the paper, and something that we should do, look at other measures of inflation expectations and see if the results are robust to using these different measures. In the regional Phillips curve, that's, remember, where we have the time-fixed effects to capture the effect of long-run expectations, but there could be short-run expectations. And so using the gasoline, prices could be interesting there. One thing we have done is we've used Michigan expectations at the census level, okay? And we've put those in addition to time-fixed effects. And there we find the results are robust to incorporating that. One caveat, of course, is that, the cross-sectional variation there is likely quite attenuated because you don't have that much variation in the data, so it might not be fully capturing, cross-sectional heterogeneity. So looking at things like gasoline prices could also be interesting. In the EU data, we also considered adding country-level expectations, which is available for the IMF, at least for a subset of our countries, not for all of them. Again, the results were robust to including those. But again, this is something that we should consider as well. Other comments. One comment was about using a time series breakpoint approach like an Andrews test or so on. So this is Bayesian that we're doing here and panel. So what we do is we use a Bayesian time series approach. So this algorithm of CHIP, which you can think of as equivalent to an Andrews test. And we run that basically on the national aggregate data. And we find that you can't detect evidence of breaks there. And the issue is the estimates are very imprecise because you don't have that much information in the data. And so it becomes very difficult to detect the breaks. And so I think that's one of the key advantages of using the cross-sectional information. You not only have more observations, but you have a lot richer heterogeneity in the data. I think that covers a good chunk of the questions, but there are probably some that I have forgotten. So if there's any remaining questions, I'm happy to take them if I didn't address them. One was about nonlinearities and breaks. So these two things are a little bit distinct because when we're talking about the break, we're talking about the Phillips curve slope coefficient becoming different over time for any state of the labor market. And so the claim that we're making is that between, say, 1980 and 2000, regardless of how high or low the unemployment rate is, the shift in the Phillips curve has become flatter in all states of the labor market in the most recent 20 years. The nonlinearity point that we're making is that there's a clear distinction within a given period of time, so say the most recent 20 years, between whether you're in a very tight labor market or a more regular labor market. And so there's this kink when the unemployment rate falls below 5%. And so the distinction is essentially the break is finding the flattening of the Phillips curve across all situations or all states of the labor market, whereas the kink is really only making a distinction between periods of a very tight labor market versus a more regular labor market. I don't remember that. Nonlinearities versus shocks. I don't remember who had that question or comment. Mark. Okay. Well, what exactly was the question? I don't remember. I'm sorry.
Maybe we can take this up
okay.
privately.
Okay. All right. Thank you.
Okay. The next paper will be on inference-based on time-varying SVARs identified with some restrictions. I invite Jonas, Arias, and to the podium to present, and the discussion will be Christian Mattes.
So if you like to walk, I can give you a microphone. Otherwise, you need to stay here, close to the microphone. Let me try. Let's try. Give me some freedom. Okay. So let me see. I've been given instruction on to put this somewhere. They told me, okay, you mind if I would on? Yeah, okay, that should work. And it should be on here. Okay. I was a bit nervous, but I was allowed to walk, so now I'm super relaxed. So this is thanks to the organizers for including this paper in the program. This is joint work with Juan Ruiz Ramirez, Minchul Shin, and Dan Wagoner. And the usual disclaimer applies. So structural vector autoregressions identified with some restrictions are popular in empirical macroeconomics since the seminal work of Ulich 2005. Since then, most researchers working with this framework adopt the Bayesian paradigm. In this environment, it is common practice to work with priors that are agnostic, in the sense that they assign the same prior probability to structural parameters that cannot be distinguished by the data. As a consequence of this, researchers working with this type of priors can be sure that only the identifying restrictions affect inference over the identified set. While this framework is appealing, it assumes that the structural parameters are constant. And depending on the application that one is trying, or the question that one is trying to answer, this assumption could be unpersuasive. This is because there is evidence of time variation in the volatility of macroeconomic variables and or in the structural relations of the economy. And here I have listed some papers with supporting evidence, and I learned today many other papers that found time variation. So motivated by these two observations, we propose a methodology for inference based on time-varying SVARs identified with some restrictions, preserving the virtues of the constant parameter case. And we illustrate our method with an application to US monetary policy. Our methodology builds upon the general class of time-varying structural models defined in Bognani 2018. This class has two ingredients. The first is a time-varying S-bar bars, which can also be interpreted or viewed as a measurement equation linking observed variables in the vector yt to structural parameters a and f. The vector xt contains the lag of the observed variables, and the vector epsilon contains the structural shocks. So for those familiar with VRs, this is just a standard vector regression with t's on a and f. The second ingredient is a law of motion for the time-varying structural parameters. And we will assume that the law of motion is Markov, so that the density of the parameters at time t depends on the parameters on the previous period, but not beyond that. So we will denote PS as the prior for the time-varying structural parameters. And we will complete the definition of the class by imposing an assumption on this prior. In particular, we will assume that this prior must satisfy the rotation invariant condition formally stated on this slide. The intuition for this condition is going to become clear over the subsequent slides. But for now, let me just intuitively highlight that this condition traces a parallel with the case of constant parameters VRs by requiring the prior to remain silent over those regions of the parameter space where the data doesn't speak. And in the context of our class of models, this simply means that the prior must be invariant to rotations of the structural parameters. Okay, so we have accomplished the first task of the methodology, which is just to describe the model. So now I'm going to go to a second part where I motivate these priors. For this, it's useful to take a moment to note that the likelihood is invariant to rotation of the structural parameters. This can be easily seen by factorizing the likelihood into t components, and then noticing that each component is a Gaussian distribution with a mean and a variance that is invariant to rotations of the structural parameters. This can be easily seen, for example, by picking a moment, the variance, and post-multiplying the matrix AT by an orthogonal matrices, and then realizing that this doesn't change the variance. Okay, so now I will formalize and summarize a few of the key ideas that I have mentioned so far. So following Rothenberg 1971, the structural parameters AF and AF with tildes are observationally equivalent if their likelihoods are equal for any realization of the data. So given this definition, we can establish proposition 1 that says that time-varying structural parameters AF and AFs with tildes are observationally equivalent if and only if there exists a sequence of rotation matrices such that the structural parameters are identical up to this rotation. So proposition 1 means that we can interpret the rotation invariant condition as a requirement for the prior to remain silent, again, over those regions of the parameter space where the likelihood is the same. This can be easily seen by factorizing the posterior of the structural parameters as the product of the likelihood and the prior. We just saw that the likelihood is invariant to the rotations of the structural parameters. As a consequence, if you require the prior to be also invariant to rotations of the structural parameters, so will be the posterior. Hence, we can interpret the rotation invariant condition as a necessary and sufficient condition that forces the posterior to be equal over observational equivalent structural parameters. What does it mean? It means like a researcher using these priors can be sure that the prior doesn't affect inference. This means that only the identifying restrictions affect inference over the identified set. All right, so we have accomplished the second task, which is to motivate why these priors can be useful for some researchers. So now let me accomplish a third task, which is how do we make this theory operational? All right? So for that, we use proposition 1 in order to note that the time-varying S bar can also be written in what it is called the orthogonal reduced form parameters. This is a standard in constant parameter VRs, and it's also useful in time-varying parameters VRs. And what is important here is the existence of an invertible mapping from the structural parameters AF to the orthogonal reduced form parameters B sigma Q. We will exploit this mapping by noticing that if we are able to impose a prior over the orthogonal reduced form parameters B sigma Q, we will denote that prior POR. If we are able to come up with a prior and then map it to the structural parameters, we will obtain the prior of the structural parameters PS. However, this prior need not satisfy the rotation invariant condition. So what do? We have proposition 2 that says if the prior over the rotation over the orthogonal reduced form parameters POR can be decomposed into 2 parts, a prior for the reduced form parameters PR. For example, it could be the prior for implicit in the work of Primiceri 2005 or Kiley and Sargent, PR. And another component, which is a sequence of rotation matrices where we impose a uniform prior given the reduced form parameters. If one is able to do that, then once we map this density to the structural parameters, we will obtain a prior that satisfies the rotation invariant condition, and we can be sure that our posterior claims are only based on identifying sign restrictions. For those that are familiar with these models, notice that in central banks there are many time-varying VRs for forecasting purposes. So many central banks can directly go and plug here a PR. And then if they are able to expand that model with a sequence of orthogonal matrices with a uniform prior, they can use the same models to conduct a structural analysis. As I said, they are one of the most famous reduced form priors could be seen as the one used by Primiceri 2005. In our case, we use another one. We use the random correlation reduced form priors that my co-authors Juan Ruiz Ramirez and Min-Chul Shin we developed. And this prior has a nice property that it is invariant to the order of the variables. So that's what we like. And it has a similar performance to the one in Primiceri's. And it is based on a time-varying extension of the parameterization for reduced form covariance matrix proposed by Arkakov and Hansen in recent work in Econometrica. So what do? So we have that reduced form prior. We expand it with a prior that is uniform over the sequence of rotation matrices. And now we want to conduct inference, posterior inference, based on sign restrictions. So for that, we have an algorithm that is described in the paper in details. But let me highlight that it features the particle Gibbs with ancestor sampling of Lindsten, Jordan, and Schoen as one of its main components. This is critical in order to be able to draw from the uniform, conditional, and reduced form parameters. In contrast, existing papers working with the sign restrictions in time-varying VRs, they typically draw from the uniform, conditional on the reduced form parameters and the sign restriction. This latter conditioning implies that they will violate the rotation invariant condition that we have seen associated with our methodology. All right, so now we went over the methodology. So now you're familiar with the method we're going to use in the application. So I'm going to turn to that. Since the latest inflation run-up, most monetary policy discussions have revolved around the effects of interest rate increases in economic activity and inflation. So the Fed has a clear mandate to restore inflation to 2%, but there is uncertainty about how much interest rates have to increase to achieve the objective. And the quote that you see on the slides is a clear example of the type of challenges that policymakers face when setting interest rates. So motivated by that, we rely on our methodology to tackle two questions. The first is, how did the Federal Reserve respond to the state of the economy during the current monetary policy cycle in tightening? The second is, how does the Fed stance during this cycle compare with the more dovish or hawkish monetary policy stance? To that end, we use the random correlation S bar that we saw in the first part of the presentation, and we specify the model at the quarterly frequency featuring 5 variables. The variables were selected in order to capture important aspects of the US economy. As a consequence, we have output growth, inflation, the federal funds rate, money growth, and a measure of credit spread. This measure of the credit spread is motivated by the work of Dario Caldara and Herbst, showing that it is important to take into account credit spreads when modeling monetary policy in structural vector autoregressions. The sample runs from 1959, Q1, until mid-2023. As we saw again at the beginning, the class of models we're working with are not identified. As a consequence, we will need identifying restrictions. We will impose two types of restrictions. Restriction 1 requires that following a monetary policy shock, the contemporaneous impulse responses of the price level and the stock of money are negative, and the contemporaneous impulse response of the federal funds rate is positive. This restriction is imposed in every period in our sample, and it is inspired in the work of Ulik 2005 that was motivated in the spirit of having some minimal set of restrictions that people could agree, even though some of you may disagree with some of those. So the second restriction has two parts. The first part is like we assume that the federal funds rate is the main policy instrument throughout our sample, except during a period in which the Fed explicitly abandoned the interest rate as the main instrument, monetary policy instrument, that is 1979 to 82, as well as the most recent episodes of the CLB, where maybe arguably the Fed funds rate was not the main policy instrument, and then quantitative easing was one of the most used tools. And I have another bullet point there to highlight for those interested in the methodology that our approach can be used to impose time variance and restrictions. Okay, so now turning to the second component, when the federal funds rate is the main policy instrument, we rely on work we have done with Dario Caldara and Juan Ruiz Ramirez, and we write the monetary policy equation as a function of a systematic component and a shock component, and then we impose restrictions on the systematic component of monetary policy. For example, if you take the coefficient psi pi t, we will assume that other things constant, if there is an increase in inflation, the Fed will tend to tighten it. Okay? And we view these as restrictions that are consistent with economic theory and institutional knowledge. Okay, so let me show you some of the results. So what you are seeing here is the systematic component of monetary policy implied by our model, and I would like to highlight that there is time variation in these parameters. Right? So similarly, there is time variation in the standard deviation of the monetary policy shock. Hence, this can be interpreted as evidence that our methodology is useful, at least in this context. So now we are ready to turn to the first question, main question of the application, which is as follows. So as we all know, on March 16, 2022, the Fed raised the federal funds rate target, initializing the current monetary policy tightening cycle. So conditional on the date of liftoff, we ask, how did the Federal Reserve respond to the state of the economy during the subsequent quarters? Answering this question will allow us to study the degree to which unexpected changes in the federal funds rate from the onset of 2022 until mid-2023 are attributable to either the systematic component of policy or to monetary policy shocks. To fix ideas, consider a simplified constant parameter version of our model with just two variables, real GDP growth and the federal funds rate. And I also have abstracted from lags and the constant. Using that two-equation system, it is straightforward to notice that the federal funds rate can be decomposed into a predictable component and an unpredictable component. The unpredictable component can be decomposed into a systematic response to non-monetary policy shock, for example, demand or supply shock, and to a monetary policy shock. In the paper, we use the composition similar to this, but in the larger model, in order to assess how did the Fed respond to the state of the economy. In particular, let's focus on the left panel, where you see the federal funds rate. And let's also fix one date. For example, let's fix 2023 Q2. The solid line corresponding to that date shows you the average level of the federal funds rate on that quarter. The dotted line shows you the predictable component. So it is what the forecaster would have predicted standing here in 2022 Q1. The difference between the data, the solid line, and the predictable component, which is the dotted line, is the unpredictable component. That unpredictable component can be decomposed into non-monetary policy shocks and monetary policy shocks. The lion's share of the unpredictable component is due to non-monetary policy shocks. And as you can see on the middle and right panel, these non-monetary policy shocks, which we do not interpret, they could have been demand or supply, we don't take a stance on that, but they were shocks that drove output growth and inflation up. That said, the monetary policy shocks also play a role, and as you can see by the red bars. Interestingly, our results kind of align with those of the Romer and Romer following the narrative approach. So Romer and Romer tentatively concluded that for them it seemed quite clear that the contraction in monetary policy shock occurred in the summer or early fall of 2022, right? Even though our approaches are different, what I'm showing you here is the time series of the monetary policy shocks recovered by our model. The green solid line shows you the posterior median of the monetary policy shock recovered by the model, and the green area shows you the 68% point-wise probability bands. As you can see, our model also picks up the shock in 2022 Q3, but also points out the shock in 2022 Q2. And if you read the Romer's paper, you can see that they also are kind of hesitant. They think maybe that the shock occurred in Q2, Q3, and they decide for Q3. Our model shows evidence for both. So that's what it is there. And I'm going to conclude by conducting two counterfactual simulations where we replay history since the onset of 2022, assuming that the Fed would have reacted to contemporaneous inflation differently than estimated in our rule. If you remember a few slides before, the notation for the rule was this psi pi t on inflation, so we're going to change that. And we're going to consider a dovish Fed scenario where we replace the model estimated reaction function to contemporaneous inflation with a reaction that is half as large. So it's a super simple change. And the other is a hawkish Fed where we replace the estimated reaction function to contemporaneous inflation with a reaction that is twice as large. Another super simple change. So the green solid line and the green shaded area shows you the posterior median and the posterior 68% probability bands for the simulated path for the federal funds rate, output, and core inflation under the hawkish counterfactual. The yellow solid line and the yellow area shows you the same object, but for the dovish counterfactual. The black circles show you the data. And let me highlight two results. First, according to our counterfactual, inflation would have run persistently above 5% under the dovish counterfactual. And in terms of the hawkish counterfactual, we find that inflation would have returned to target by the middle of last year under that counterfactual. And then in terms of how costly would that have been in terms of output, then that depends on the loss function of the policymakers. If we want to look at the posterior median, the solid green line, it doesn't seem to be as large when compared to the data. But if one is concerned with being at lower end of this 68% probability band, then the cost could have been much larger. So to conclude, we offer a methodology for researchers that are interested in conducting empirical work using these priors that assign the same density to observational equivalent structural parameters. And there are many extensions that could be considered, such as zero restrictions, doing marginal likelihood comparison across models, and exploring the role of inference on the fixed parameters that we didn't have time to talk about. So thank you very much.
So first, thanks to the organizers for giving me the opportunity to discuss this paper. It's really a great paper. It's definitely going on my syllabus for my PhD class next year. So that also puts me in a bit of an awkward position because there's really not much to talk about. So what I'll do is I'll give some big picture overview of where I think this paper fits in the literature, and then I'm going to nitpick a little, okay? So first I want to talk about empirical strategy more broadly. Again, where does this paper fit in the literature? How should we think about estimating structural VARs? And here I'm going to start with the key assumption that Jonas already put up. That's the law of motion for the parameters in the structural VAR. And it says, as Jonas said, this law of motion is invariant to any rotation that leaves the first and second moments of the data untouched. Now, since this law of motion is not dependent on the data, we can think about this alternatively. This PS density, we can think about that as the prior for the structural VAR parameters over time. And Jonas and co-authors imposed this condition for all Q for all rotation matrices. Okay? And why is that? Well, because they think about this prior as being distinct from identification restrictions. So they don't want this density to encode any identification restrictions. And I'll talk about in a second why that is a useful assumption. However, in empirical macro, there's also an alternative where, if you think about the fixed coefficient case, in particular their work by Baumeister and Hamilton, who've really popularized this, even though they were not the first to do this, you could alternatively encode identification information in priors about A, right? A, if I remember correctly, yes, I think so, A is the matrix that encodes contemporaneous relationships between variables. And so we could directly encode any identification assumptions we might want to make, in particular, for example, about response coefficients of the monetary policy rule directly in this prior. That would be an alternative, but that would rule out certain rotation matrices. Okay? So there's this kind of, when you write down a structural VAR and you want to estimate it, there's this distinction. Either do you first want to estimate something that doesn't take into account identification restrictions, or do you directly want to encode them? Now, what they do makes perfect sense. It makes perfect sense for a number of reasons. First, this rotation invariance is useful because otherwise, for example, the ordering of the variables can matter. This is something that was already alluded to in the original Primiceri restart paper, and that was then largely forgotten for almost a decade in the literature, and then was put back front and center in the literature in this great paper by Mark Bognani that Jonas also cited. So we have, when you write down structural VRs, you have these alternatives: identification assumptions via prior or ex post. Jonas and co-authors go this ex post route. And why is this really a useful way of going about things? Here I find proposition 2 really helpful. So remember, proposition 2 told us about, well, if you want to have this rotation invariance, then you can really think about having priors on reduced form parameters and an independent prior on this rotation matrix. And that is really useful because prior elicitation on reduced form parameters is much easier than prior elicitation that incorporates identification information on the structural VAR parameters. Okay? And I can say this because I've worked a lot with directly putting identification restriction on structural VAR parameters, and it's hard because sometimes you have identification, you have information on that you can use for identification for one shock or for two shocks, but not for all shocks in the model. So the route that Jonas and co-authors take, I think, is really a very useful route to take for prior elicitation. Now let me talk a little bit about impulse responses and priors. So first, the paper, as Jonas said, provides an algorithm so that you can draw from the proper posterior distribution of the VAR parameters conditional on the sign restrictions. Now, people have tried to draw from this prior before, but they've taken shortcuts. It would be useful to figure out or to have a sense for maybe one or two specific applications how much of an error we would make with the standard approach that many people, including myself, have used in the past. Jonas already mentioned that this paper is, I think, the first in the literature to really emphasize how to impose sign restrictions for select periods only. And I think that really opens up whole new avenues for research, for applications. I really like this. One thought I had as I was reading the paper is that the application is all about these time-varying parameter models where the parameters vary according to random walks. Could these results be extended to other models with time-varying parameters, such as Markov switching models and the like? That'd be kind of something interesting to figure out. Now, let me talk a little bit about priors. This goes back to one of the extensions that Jonas mentioned at the end, namely these fixed parameters, these phi parameters in his notation. These are the parameters that govern how much time variation there is, how much change there is in volatility from period to period, and how much change there is in other parameters in the VARs. It turns out that the priors on the amount of time variation that are encoded in these parameters are really crucial. Meaning, depending on what prior you pick, you can either get estimates that tell you most of the time variation comes from stochastic volatility versus most of the time variation comes from changes in parameters. Now, in previous work that I've done with Puyan Ahmadi and Mu-Chun Wang, we had a paper where we actually laid out one, we thought, reasonable way of actually estimating these hyperparameters in the classical Primicherry-Cogley-Sargent class of models. So I think doing something similar here in this more general class of models would be really useful. Now, I want to say also, because these priors are so important, they can influence model choice. So Jonas said, well, you know, we picked a certain class of time-varying parameter or stochastic volatility models because they best fit the data. I wonder if that choice is sensitive or not to the priors that they're imposing. Now, if this class of models that they're using is more robust to the choice of priors, I think that would be a really useful finding. And here, I can give you one example for why this matters. So here we take a standard Cogley or Primicherry, Cogley-Sargent or Primicherry type time-varying parameter VAR, and we produce long-run forecasts for inflation. This is joint work with Richie Sparnichon and two of my students. Why is that a useful thing to do? Well, because a lot of people want to interpret long-run forecasts as trend values. And you can see these different lines, they all respond to different values of these hyperparameters in these time-varying parameter VAR models. Hyperparameters, these phi values, that have been used in the literature before. So even within values that have been used in the literature, you can find a huge discrepancy in what you would call a trend rate for inflation. Now let me wrap up here, if I have another minute, with some discussion about the application. Coming back to my previous point, I think it would be really useful to see how much time variation there is in impulse responses. Because with a standard prior setting as in Primicherry, what a lot of people have found in the past is that once you control for changes in the size of the shock, the impulse responses to monetary shocks look very similar across time. Here, if you find something different, I think it'd be really useful to report. I have a very nitpicky comment here about something that Jonas didn't even show in the presentation, so I'm not going to mention that. It's about comparing fixed coefficient VARs and time-varying parameter VARs. Instead, let me just conclude and say, this is a great paper. I learned a lot. I think it's really pushing the envelope on what we can do with time-varying parameter models. And there's a lot that I have learned. I think I'll learn a lot more as the paper evolves. Thank you.
Okay, any comments out there?
I like the paper a lot on us. I had the one question regarding, like as an end user, how one can use the model. So let's say the reaction function can have either a high response to inflation or a low response of inflation, and this response is time varying. And now, there could be, in an underlying macro model, that could be the only parameter that changes. But when that parameter changes, because there are expectations and agents anticipate that this thing is going to be there for a while, also the reduced form response of, say, GDP or inflation to monetary policy does change. So when I think about reduced form, you change one parameter and many others change in the dynamics of the economy because one parameter changes. But in the structural form, only one parameter is changing. It's just the response of the fundamental response of monetary policy to inflation, let's say. Now, is your method basically capturing that? So the fact that, you know, when I think about reduced form dynamics, one parameter changes, but there's a lot of other stuff that goes on. So parameters are actually correlated if I think about the reduced form representation of the VAR, or I'm barking up a completely implausible tree, so I should not think that way.
Thank you very much. Very nice paper. Again, I'll be on more of the applied side. So you do this breakdown in your application where you kind of try to break this aspect of monetary shocks after, you know, the liftoff in 2022 between the systemic part and then kind of the shock part. Then I'm just trying to figure out how you're doing it in the sense that prior to that, inflation was going up. So kind of a normal rule would have said interest rates should have gone up higher. Then they kind of go up. So is that like you restart it at that point and kind of build it? Or how is it? Because you could have thought, well, there's all this kind of, there should have been going up, and how do we kind of put that in that part? Anyways, if you can explain a little bit more how you do that break so I can understand. Thank you.
Yeah, can I just have a follow-up on that? Jonas, if you try to start earlier, say you treat 2020 Q4 as the initial state, and then you run forward as suggested by Paul. I think it would be interesting because maybe your model implies that the, say, easy policy stance during the initial part of the inflation surge, maybe monetary policy didn't do too much, was not as sort of effective as later, so that maybe say the sort of loose stance initially were more than offset by, say, tighter stance down the road when policy indeed tightened. Anyway, it would be good to see.
Great paper again, and as well I learned a lot. I also enjoyed very much the discussion by Christian and lots of great points there. Today we have seen and we know there is a lot of debate about demand and supply as drivers of recent inflation, and the way you selected the variables in your model, you could speak to that, and you could even, you know, adding restrictions, go into thinking about supply versus demand shifters, and you also have financial conditions or money growth that could maybe be used to think about monetary policy or policy when you're at the ELB. So I was wondering whether that could be a way of extending the analysis. So instead of just focusing on monetary policy shock and everything else, try to exploit the richness of your model to go and identify demand, supply, and financial shifters in financial conditions.
So first, thanks, Christian, for the great discussion.
Okay, thanks, Christian, for the great discussion. So I think, yeah, we have a lot of work to do, and I think it's going to be super helpful. And so we're going to take, I already wrote down in my mind what we have to do, but I'm going to ask you for the slides and do the work. So the one thing I wanted to highlight, because it's something I learned writing this paper, is like, I don't know if I can take a moment to look at the slides about the... This maybe like just one comment is like regarding the ordering of issue in Primicheri's model. So what we say here is, yeah, so here, this model PR, this reduced form prior is subject to the ordering. So if you change order of the variables, this prior is going to change. But as a matter of fact, that doesn't imply that the rotation invariant condition is not going to be violated. So one could work with Primicheri model perfectly fine in our framework. Now the question is then which one, which ordering? Yeah. And then that's where maybe using your approach to estimate the hybrid parameters and then marginal likelihood comparison can be super helpful. Okay, that's it with the slides. So now I'm going to turn to the question by the ones that they can answer best first. So Paul and Jesper. So so in the paper, we have a discussion about basically whether the Fed was behind the curve. And we conduct this exercise starting earlier than in 2022 Q1. And we see that there was a call for higher rates according to the model. So the predictable component says we should be lifting off. However, interestingly, we also find that the fact that the Fed didn't lift off didn't come at a high cost in terms of inflation. So that expansionary shocks in the way that the model captures basically the lack of increasing rates is as expansionary shocks. And those didn't contribute much to inflation through the lens of our model. Of course, everything is more dependent, but that's what we find. So then I think, so to Mateo's point about the structural parameters, so we are using, I think Christian explained it well, so we're using this approach of eliciting priors in the reduced form parameters and then transforming them, but at the end of the day, we care about the structural parameters. So it would be nice, we could explore the correlation between the parameters and see how they correlate, but we haven't done it so far. I think it's a very interesting thing for us to explore. Regarding your question can also be interpreted as a criticism for the counterfactuals, because you can think that people who learn, we assume that we changed the coefficient, but people didn't learn. So to address that concern, we also have like a counterfactual that is robust to concerns of the Lucas critique, where we obtain similar results to the one that I show you, but just surprising the agent in the model by just one anticipated monetary policy shock. And then, Darius, that's a great suggestion. And we're looking into that. The reason we didn't dig deeper is like sometimes for these additional shocks, the zero restrictions are helpful. And so we are trying to kind of expand this approach to be able to impose zero restrictions before going into the identification of the other shocks. And I'm not sure if I missed any question, but that's what. Yeah. Yeah, thank you.
Okay, we take another coffee break and we resume at 4 p.m. for Mark Gertler's keynote.
in. Okay, so my name is Peter Karadi. I'm an economist at the European Central Bank, and on behalf of the organizers, it's a great pleasure to introduce Mark Gertler as today's academic keynote speaker. So Mark doesn't really need an introduction, so I can be brief. He's a NYU professor. He's one of the most influential macroeconomists I've recently checked. He has almost 100,000 citations, and this is thanks to his over 70 papers with both theoretical and empirical contributions on issues ranging from monetary transmission, financial frictions, optimal policy design, among a lot of others. So his papers are both highly policy relevant and contribute to the academic debate with elegant formalism. So it's not no surprise that they tend to motivate quite a few of us here to build on his work. So and today's keynote is no different. So please join me. Welcome, Mark, and Mark, the floor is yours.
Okay, thank you very much. It's great to be back at the Federal Reserve Board. I'm also touched to see so many former students, including Peter, who are in the audience. I'm not saying whether this is good or bad for central banking, but it's kind of nice for me. Okay, so what I'm going to do is talk about some ongoing work with Luca Gallardorn, who's an outstanding student at NYU, Simone Lenzo of Stern, and Joris Tielens of the Bank of Belgium. And what we've been doing is taking what you might think of as a bottom-up approach to inflation. We've been looking at the pricing behavior of individual firms and then aggregating up to see what the determinants of inflation are. And to motivate today's talk, let me say, if you have clarifying questions, please interrupt. But to motivate today's talk, let me show a picture of two variables. The first is producer price inflation year over year. The second is the quarterly price adjustment frequency. And this is data from 1999 through 2023. Comes from the Belgian manufacturing sector, but it's pretty representative of what you'd find in the G20 countries. Inflation is the red dotted line, and you see before 2020, inflation is relatively low and stable, but then you see the surge in 2021, and then the eventual collapse. And this is pretty typical of what's happening to goods market inflation across the industrialized sector. Now, the frequency of price adjustment, that's the black line, that's also reasonably stable prior to 2020. There's a bit of a downward drift in the last 10 years of the pre-pandemic sample, but that frequency is reasonably stable. It's about, a quarterly frequency is about 0.3, which means about 30% of firms change prices each quarter. And that translates into roughly 10 months, 11 months that prices are rigid. And that's pretty consistent with US data as well. But then what you see when the pandemic, after the pandemic hits and we get the inflation surge, you see a big jump in the adjustment frequency. It more than doubles. And what I'd like to do in the talk today is give you a framework that can provide a unified accounting of both the pre- and post-pandemic inflation. But first, some background. What we did in our earlier work was focus on the pre-pandemic period. And we were motivated by the challenge that it's difficult to identify a strong link between inflation and conventional measures of real activity, including the gap between output and the natural rate and the gap between unemployment and its natural rate. And you saw some of that discussion earlier today. And where you see it is these hundreds of papers that estimates Phillips curves and find low slopes. And here I've illustrated the standard New Keynesian Phillips curve, which relates inflation to the output gap plus expected future inflation. And typically the estimates of kappa, the slope coefficient, were very close to zero. The implication is that inflation was basically explained by this unobserved residual UT. Sometimes it's called a cost push shock, sometimes a market shock, but it's unobserved, and basically, if that's what you're relying on, you don't have an explanation. So what we did instead was focus on the marginal cost-based Phillips curve, which relates inflation to the deviation of marginal cost from trend. And the attractive of this approach is this Phillips curve is tied directly to the underlying microeconomics of price adjustment. You get it, as many of you know, by aggregating up the individual pricing decisions of firms who set price based on current and expected future marginal cost. And in fact, the way we estimate this relationship is we use firm-level data to estimate the underlying pricing relationships. Then we aggregate up to get an estimate of lambda. And just as Silvana noted a number of years ago, you get more power using microdata, and that's what happened with us. So we get significant and high and large measures of lambda. And an additional implication is that conditional on the variation in marginal cost, you explain most of the variation in inflation, at least in Belgian manufacturing. Okay, what happened? What's going on with the output gap-based Phillips curve? Well, you can decompose the slope coefficient on output into the product of the slope coefficient on marginal cost, that's lambda, times the elasticity of marginal cost with respect to the output gap. And what we also present some evidence that this elasticity, the elasticity of marginal cost with respect to output, was really low. Or put differently, over this period, the aggregate supply curve was quite flat. Now, that doesn't mean it's going to be like that always, or that it was like that in the last few years. In fact, Gianluca presented an example earlier where if you have capacity constraints, this elasticity could go up. But at least for that period, the elasticity was flat. One more point, how do you move from the marginal cost-based Phillips curve to the standard New Keynesian Phillips curve? You have to make assumptions that marginal cost is proportionate to the output gap. And in general, that's not true. For example, if you have wage rigidity, that's not going to be true. And that's why if you look at the standard DHG models with wage rigidity, they use a marginal cost-based Phillips curve. It's just, I'm going to argue, this is the point I want to get to, is they don't have an adequate characterization of marginal cost. But I'll get to that later. Bottom line, in our earlier work, we found that the marginal cost-based Phillips curve actually works pretty well, but one caveat. Like the literature, to motivate nominal rigidities, we assume Calvo pricing, which assumes that firms face a fixed exogenous probability of adjusting price. And the data I just showed you, that's okay pre-pandemic, but it's not okay post-pandemic, okay? So what we want to do now is extend the analysis to post-pandemic inflation. And this suggests we're going to have to allow for state-dependent pricing, where the adjustment decision is endogenous, to capture the jump in the price adjustment frequency. Now, there are other menu cost papers that recently have shown how a menu cost model can help capture what's going on in the recent inflation surge. What's the difference from what we have? Well, these studies typically only have micro price data, okay? Then in a very clever way, they can use the model to infer what costs might have been given the price adjustments. The advantage we have is we have a unique data set that gives us information not only on firm prices, but also on firm costs. And what does having the price and cost data allow us to do? We can build measures of firm price gaps, which is the distance between the ideal price the firm would like to have and its current price. And that's a critical building block of the menu cost model, because the price gaps are going to determine both the size of the price change and the frequency of the price change, as I'll show you. And in fact, price gaps even play a role in the standard New Keynesian model. They determine the size of the price adjustment, but the price adjustment is exogenous in the standard New Keynesian model. So that's the first thing it allows us to do. The second thing is we can construct an aggregate marginal cost index, and then we can see, given the model and given the variation in this aggregate marginal cost index, how well can the model do in explaining inflation, okay? Or put differently, we have an observable measure of the relevant shock. All right, we're going to get three main results. First of all, the microevidence is going to show that pricing is going to be nonlinear in the gap between the ideal and actual price. And this is going to be consistent with state-dependent pricing, because where's the nonlinearity going to come from? It's going to come from the fact that the adjustment probability is going to change, okay? Also, the model's going to account for the time series of inflation, so it's going to explain the inflation surge. And it's also going to explain the cross-section of firm price changes. So we're going to let firms vary by their price gap, and we're going to show that the variation in price changes is going to be consistent with the model. And in the end, we're going to be able to capture the inflation surge, and marginal cost is going to be the driver of inflation, as it was in our earlier work. Finally, you don't need to get rid of the Calvo model. I'm going to argue that the Calvo model provides a good approximation in normal times. So price dynamics are going to be linear in normal times. That's what the Calvo model says, but nonlinear during the inflation surge. Okay? All right. So this work is kind of borrows from the menu cost literature, and then also the micro panel data, Phillips curve literature. Papers probably closest to work my colleague Virgilio Midrigan, who also has a paper on menu costs and the inflation surge, and also a series of papers by Francesco Lippi that's doing something similar, okay? And we differ again because we are making use of the cost data. All right, so what I want to do is present the theoretical framework, and I need it to organize the empirical work I do. So I'm just going to sketch it, then talk about the data I used. Then I'm going to show you how the model is consistent with the evidence on micro behavior, firm level behavior, and then show you how it does reasonably also on aggregate behavior. Okay. All right, the model is a variation of a standard menu cost model. It's discrete time, and firms face fixed costs of adjusting price. Okay. Because in the data there are small price changes, okay, and menu costs would suggest you should only see big menu costs because you got to cover the fixed costs. Because there's small price changes, we introduce random free price changes, and this is something Nakamura and Steinson did for this reason, and they dubbed this the Calvo Plus model. Because price adjustment is a probabilistic function of price gaps, and it's not 0, 1, we allow for random menu costs, and this dates back at least to Calbiero Engel. We're also going to do a quadratic approximation of the profit function, and this makes the math easier, I should say, not easy. We're going to show, in fact, that the data is consistent with this approximation. And then finally, in the analytical model, we're going to work with zero trend inflation, again, to keep things simple, but when we go to the quantitative model, we'll allow for trend inflation. Okay. All right, a sketch of the model, the key concepts. First, the target price, P0 Ti. Where does this come from? Well, in the background, There are a continuum of monopolistically competitive firms indexed by I. Each sells a differentiated product at log price PTI. Each faces a constant return to production, to scale production function. We're going to relax that in the empirical work. Then, because we found it in our earlier empirical work, we allow for strategic complementarities in price setting, which those are mechanisms which dampen price adjustment. We're going to use the Kimball variety, which give a motive for firms to try and keep their price close to their competitors' prices. Finally, for technical reasons, we need unobserved idiosyncratic demand shocks, but I'm going to not put them down here to keep the algebra simpler. So given these background assumptions, the optimal reset price, the target price, that's the price the firms would like if prices were perfectly flexible, or if they could change price each period, okay? The flexible price equilibrium. P0 Ti is equal to a markup, mu, over a convex combination of marginal cost and the price level, which reflects competitors' prices, okay? And what omega is, that's the degree of strategic complementarity. So if omega was 0, no strategic complementarities, price would just be a markup over marginal cost. This is in logs, okay? But as gamma goes up, firms pay less attention to their own marginal cost, more attention to competitors' prices. Okay, marginal cost of the firm is a combination of aggregate marginal cost, MCT, plus an idiosyncratic component I'm going to call ATI. And I'm going to assume that the aggregate component is a random walk. Okay, in the data work, it's going to be a random walk with drift. That's consistent with the data. And we're going to assume that the firm level component of marginal cost is also a random walk. And this is going to make life a lot easier, as I tell you in a few minutes. Okay, so that's the target price. Now, the price gap, the next key concept. The price gap is the gap between the firm's current price, PTI, and what its target price is, and I'm just going to write it as XTI. And again, what's the optimal price gap for the firm? It's 0. They'd like its price at P0. So that motivates me, following the literature, to take a quadratic approximation of the profit function around the 0 price gap. So we can express period profits as a constant, which I'm going to ignore, minus the deviation of the price gap from 0, or the square of the deviation of the price gap from 0. Okay, so that's the loss function. Now, as I said earlier, firms pay menu costs, which are random. Chi Ti is this random menu cost. Okay, we assume that the distribution it's distributed uniformly over the range 0 to chi bar. Chi bar is the maximum menu cost. If that's the case, we can write firms' discounted profits as a combination. I is an indicator function, which is 1 if the firm pays the menu cost, and 0 if not, and this is an endogenous decision. So I could write discounted profits is the bottom function. It's going to depend upon profits, net whether or not the firm adjusts and pays the menu cost. And the firm's going to want to choose optimal sequences of the price gap and whether or not to pay the menu cost. Okay. All right. A few more things before we get to the data. Now, a critical concept, I've told you about the price gap, now the ex-ante price gap, and this is important because this is going to determine the price adjustment probability. Okay, what's the ex-ante price gap? It's the price gap at time t, okay, or the difference between, well, let me say it differently. It's the price gap at t before you adjust price. Okay, so before you adjust price, you have PT minus I. That's your price from last period. Okay, but P0T is the target you would like in period T. Okay, so what's going on? You enter T, there's a bunch of shocks which have affected what the target price is, okay? You haven't adjusted yet, okay? That's the ex-ante price gap. And what's going to cause the ex-ante price gap to differ from the price gap in the previous period? It's going to be the shocks that determine the target price. So eta was the shock to the macro shock to marginal cost. Epsilon TI is the idiosyncratic shock to marginal cost, and prices can change, okay? That's what causes the ex-ante price gap to change from last period's price gap. Now, whether or not you adjust, it's going to depend upon how far you are from the optimum time t. So it's going to depend upon the ex-ante price gap, okay? So that's what determines the adjustment probability, okay? Questions? Okay. All right. So what's the adjustment probability? Well, it depends upon two parts. First of all, you may get the random free adjustment. That happens with probability 1 minus lambda. However, with probability of lambda, you don't get the free price adjustment. Then whether or not you adjust is going to depend upon whether the value of adjusting, which is VA, net the menu cost, exceeds the value of not adjusting, which is the value conditional on the ex-ante price gap. Okay, and because of the uniform price distribution, menu cost distribution, we can write that as just that probability is depending upon just the gap between the value of adjusting versus the value of a not adjusting scaled by the maximum menu cost. Okay, that makes things a little easier. Okay. All right, price dynamics. Okay, 2 more model slides. Okay. All right. Let's let P star be the optimal reset price. Okay, why is that different from the target price? Okay, the target price is where you'd like to be if prices were flexible and you could always adjust. The reset price, it's just kind of like in Calvo. Reset price takes account of the fact that in the future you may not be adjusting price, at least in some periods. Okay, so that's the optimal reset price. Okay, so the reset gap is P star, the optimal reset price, minus the target. So now we can talk about what firm pricing policy is. Okay, firm pricing policy, okay, with probability H, okay, the firm, that means it's going to adjust with probability H, which depends upon the ex-ante reset gap. And if you adjust, you're going to have reset gap X star, okay? If you don't win, that is, you don't get to adjust, then you're just stuck with the old reset gap, okay? All right, and again, the reset gap is going to be driven by the shocks, including both the macro and the micro shocks. Now, here's where our random walk assumptions come in, okay? That because marginal cost is a random walk and the price level is not far from a random walk, there's not much difference between the optimal reset price and the target price. And again, the target price is the price you would choose if you could adjust each period. The optimal reset price takes into account that you may not be able to adjust. But because the relevant shocks follow random walks, quantitatively there's not much difference between the two. Now, why is this important? Okay, this is what I want you to get out of this. What we want to do is measure these price gaps. And that's going to depend upon being able to measure either the reset price or the target reset price. But if the reset price is roughly the same as the target price, that's something we can measure, okay? So the markup is a constant over time, okay? So that we can figure out over time, just with taking a fixed effect out. But we can measure the firm's marginal cost and we can measure the price index. So by making this simplification, we can measure the target price, okay? That's the key thing here, okay? This is what's going to let us measure price gaps. Okay, now a useful way to summarize how the model works is with the following diagram. This diagram is going to be generated by the model. I'm going to show you that the data is consistent with this diagram as well, okay? Now, on the horizontal axis, I measured the price gap. So P0, which I just showed you how I can measure, minus PT minus 1, which I can also measure. So what's true? At 0, that's when the firm's price gap is equal to 0. As we go to the right, the desired price is above the actual price. So as we go to the right, these firms are going to want to increase their price. And the only reason they don't is because of the menu cost. If we go to the left, P0 is less than PT minus 1. These firms are going to want to reduce their price, okay? Now, what determines whether or not they increase or not? Well, the V-shaped function, that's called the generalized hazard function. That gives the probability of adjusting as a function of the reset gap, okay? Now, suppose the gap is close to 0. All right, what this, in this case, this example says that the frequency or probability of a price adjustment is about 20%, okay? So what's that? That's the probability of a free price adjustment, okay? There was no reason to because the gap was, or there wasn't a large reason to because the gap was small, but you got a lucky draw, and so you were able to adjust if you wanted to. Okay, all right, now, as you move to the right, you increase the price gap. What happens to the price adjustment probability? It goes up. Okay, that's what this, oops, did I lose this? Yes. Okay, the price adjustment probability goes up. So as the price gap increases, firms are more likely to adjust their price up. Conversely, if the price gap shrinks, you go to the left on this axis, the probability firms reduce their price gap. Reduce their price goes up, okay? All right, so that's the generalized hazard function, okay? And this is going to be the source of the nonlinearity because it says that price gaps really get big, for example, adjustment probabilities go up, okay? And that's the extra effect that gives you the nonlinearity. Now, what about the bell-shaped function? That's the distribution of price gaps, okay? And why is it bell-shaped? Well, that's simply because as the price gaps increase, the probability of adjusting goes up, and then firms go back to the middle of the distribution, okay? That's the reason for the bell shape, okay? One more slide of math. Now, in the end, there's going to be a nonlinear relationship between marginal cost and inflation, okay? And how do we get inflation? Well, we just sum over individual firms. That's the left side of this equation. For each firm, what's its inflation going to be? It's going to be the adjustment probability, which is H, times what the price gap is, okay? But note that the adjustment probability itself is also a function of the price gap. So you're working along two margins. Price gap goes up, you want to increase more, but also you're more likely to adjust, okay? And this is sometimes also called the selection effect in menu cost models because the firms with big gaps are also the firms most likely to adjust, okay? All right, and how can we see this? All right, well, here are two shocks, two cases. One is small shock versus large shock. If you will, think of this as pre-pandemic versus post-pandemic. That's what I'm going to show you. All right, so the solid line is still the steady state position. Then there's a positive shock, but it's small, and that shock is going to shift the distribution. So you're going to have you're going to increase the fraction of firms with positive price gaps that want to increase, and you're going to reduce the fraction of firms which have negative price gaps and want to decrease prices. So on net, inflation is going up. But if you look on this diagram, there's not that much change in the price adjustment frequency, okay? It's just not enough to move things. Now, if you have a big shock, you really shift the distribution far out, and what's going to happen, not only are you increasing the average price gap and increasing the inflationary pressure, you're also increasing the adjustment probability, and so that's where the nonlinearity comes from, okay? And again, this is pre-pandemic as a small shock, think of it that way. post-pandemic I'm going to show you is the big shock. All right, data. Okay, this is data from Belgian manufacturing. We have information on production and prices. Also detailed information on costs. And the important thing is that the costs contain both information on intermediate inputs and also information on wages, okay? All right, universal coverage, and then also our price data is consistent with the official Belgian SATA. So the data seems reasonable. Okay. We have to take in, well, I guess I can skip this. So we construct price indices at the prices for each firm. We can aggregate across firms and construct the price indices for the industries. That's going to give us competitors' prices. Now, an important variable is marginal cost, because my claim, the whole advantage of what we have is we can measure these price gaps, and the desired price depends upon marginal cost. So how do we measure marginal cost? Okay, we make the assumption, which holds under general technologies, Cobb-Douglas and CES, that we can write marginal cost as depending on industry factor, firm level cost shifter, and firm level output to the power nu. And the parameter nu captures returns to scale. So if you have constant returns to scale, nu is 0. Okay, so output doesn't matter. With decreasing returns, nu is positive, and increasing returns, nu would be negative. Okay? All right, then you can show, given this assumption, that marginal cost is proportionate to average cost, and then the returns to scale factor comes in the constant. Okay, so we can allow for firms to have different returns to scale. And so what's average cost? It's total variable costs, which is the sum of the wage bill and intermediate costs, okay, relative to output. Okay, then finally, how do we measure the price gap? Okay, the ex-ante price gap, if you call, it's the lag price, okay, minus today's target price, which depends upon marginal cost of the firm and the price level, okay? All right, so I showed you earlier what our measure of marginal cost is. We're just basically using average cost for marginal cost, okay? All right. Okay, I guess I can skip this. All right, micro evidence. All right, there are 4 predictions of the model for the micro behavior of the firms, and I'm going to take you through each one and show you how the data is consistent. Then I'm going to go to the aggregate data. All right, the first prediction is that the adjustment probability depends upon the absolute value of the price gap. And in fact, Alvarez and Lippi have shown that a quadratic function provides a good approximation for the generalized hazard function, okay? In other words, this function, the V function, is characterized well by a quadratic. And I'll show you, in fact, that that's in the data. Okay, so what did we do? We have observations on firms, indexed by both firms and time. We can take these observations, okay, and put them into different bins according to the size of the price gap. So what we did was create 100 bins. Then we take the firm time observation, we look at its price gap, and we decide which bin to put it goes in, okay? All right, then for the firms in the bin, we can measure the frequency of price adjustment, okay? And that's the red lines, okay? That's the this is how often firms, for example, the 0, that tells you how often firms with a near 0 price gap adjust their price, and we can go up and down. So this is what, the red line is what the data looks like, and in fact, that fits a quadratic pretty well. Then what we can also do is measure the distribution of price gaps. Okay, again, this is data. And this looks like the bell-shaped equation that I showed you earlier. Okay, so it looks like the model is consistent with the implications of state-dependent pricing. You go further out, price gap goes further out, you're more likely to adjust price. Okay, just as the microdata said. The second prediction is that the macro shocks, particularly large ones, are going to shift the distribution. And that's going to affect the adjustment, both the size, the average size of the adjustment and the probability of adjusting, okay? So here what we did is we looked at the distribution of price gaps prior to 220, that's the black line, okay? Then we looked at 2021 Q2 and looked at what happened there. And there was a big shock to marginal cost. Marginal cost went up 6% in 1 quarter, which is a pretty large change. The dashed red line is how the distribution of gaps changed. So it moved in the direction where the price gaps were positive. The desired price, P0, increased relative to PT minus 1. So what does that imply? That implies the average price changes are going to go up, and the adjustment probabilities are going to go up as well, and that gives you the nonlinear effect. And I'm going to show you that's in the data when we look at how well the model does. Okay, prediction 3, which is my favorite one, okay. There's a nonlinear relationship between price gaps and inflation at the firm level, and when you aggregate up, you're going to see it at the aggregate level as well. So think about a firm, the group of firms that are in one of these bins. They have a given price gap. I put all of these firms in these bins. What's the inflation, the average inflation of the firms in these bins going to be? Well, it's the adjustment probability, HJ, okay? I'm calling that the adjustment probability, the average adjustment probability for firms in bin J, times their price gap, the difference between the desired and last period's price, again, for firms in bin J. Well, so in the Calvo model, this is linear because H, the adjustment probability, is fixed. Okay, but in this model, okay, the adjustment probability obeys this quadratic function where the gap squared enters. Okay, so the adjustment probability depends upon the gap squared. We'll substitute in for H, and inflation then for this group of firms is characterized by this cubic function. Okay, that's the prediction. And in fact, you could, okay, again, write the price gaps on the horizontal axis, write inflation on the vertical axis. Okay, the red line is the fit of this cubic function through the data. And in fact, this is what you get, okay? In the middle, okay, in the middle, say between a price gap of minus 10% and positive 10%, okay, this curve, this function's pretty flat. And I'll explain what that means in a second. But then let the price gap get really big. What happens is inflation goes up. It's nonlinear. Okay, the same thing on the other end. As the price gaps get really low, inflation drops. Okay, now what's going on in this middle part? Okay, so here the black dashed line we fit to the firms who are in the middle, in between 10% and positive 10% price gap, and they have basically a constant adjustment probability. This is Calvo. Okay? In fact, again, if H is constant, this tells you inflation in the gap should be the price gap times this constant inflation, constant adjustment probability. And I told you pre-pandemic, this adjustment probability was about 0.3, okay? So what do we get in the data here? This is about 0.3. We estimate 0.28, okay? So this is Calvo behavior in the middle. So what's going to happen during the inflation surge? Well, the shocks are going to move this price gap, shift the distribution of price gaps to the right, so you have more firms with large price gaps and you're going to see this nonlinear behavior. Okay, and I'm going to show you this arises in the aggregate data as well. Okay. All right, one more micro prediction before we go to the macro model. And that is, there should be a nonlinear relationship between inflation and the frequency of price adjustment. And why is that? Well, again, a small shock has only a small increase in inflation and a negligible effect on the frequency. But a large shock is going to have a significant effect on inflation, and you need a large shock to get large inflation. Okay, and we can see that that's in the data. So here, we're taking each period and we're measuring producer price inflation and the frequency of adjustment for that period, okay? Then we're fitting this quadratic, okay, which is showing that as inflation goes up, okay, you get this nonlinear relationship between the frequency of a price adjustment and the level of price inflation. And these dots over here are all from the inflation surge, which have high inflation and high frequency of price adjustment. And then we look at periods where manufacturing inflation was under 10% and fit a line that's flat. Okay? All right? All right, now let's go to show how the model works. Okay, I guess time suggests I'm going to skip the calibration. Okay, all right. Let's first of all see how the model works. Then what I want to do is simulate the time series. Okay, first how the model works. All right. Let's consider shocks of different size, a 2%, 10% shock to marginal cost, and a 20% shock to marginal cost. And let's compare Calvo to menu costs, okay? And my argument is for low shocks, small shocks, there shouldn't be much difference between Calvo and menu costs, but as the shocks get larger, you really start to see the difference. So for a 2% shock, you see, let's look at the bottom panel, which is frequency of price adjustment. For a small shock, you don't see any movement in the frequency of price adjustment with menu costs. 10% shock, you do see some movement. The frequency of price adjustment goes up to 0.36, and therefore you see more inflation in the menu cost model than you see in the Calvo model. Big shock, the nonlinearity kicks up even more. The price adjustment frequency goes up to 0.6, which is what happened in the data, and that was with a 20% shock, okay? Calvo's still stuck in this linear world, all right? So the model has the nonlinearities consistent with the microevidence I discussed earlier. One other point, and this has been emphasized by Francesco Lippi, and it's going to be true in the data, is that menu costs is going, in general, or for standard shocks, menu cost is going to give you a bigger initial effect but less persistence. And why is that? That's because you're front-loading the price changes, okay? So let's look, okay, small shocks, not too much difference between Calvo and menu costs. The large shocks, you see a big jump with menu costs, but then inflation drops, whereas you look at Calvo, it's much more persistent. And I'm going to show you, in fact, that this is in the data, okay? All right, macro time series implications. All right, so now what I want to do is feed in marginal cost into the model, the observed measure of marginal cost we have, and then see what happens. Now, to give you an idea of what the shock was and how significant it was, in this figure, I'm plotting inflation, which is the dashed red line, against marginal cost, which is the black line. Now, the first point is, note that the scales are different. Okay, the scale is much bigger for marginal cost, so actually the variation in marginal cost is much bigger. And what I'm doing is plotting PT minus 4, that's year-over-year inflation, then marginal cost relative to PT minus 4. And what the model says is if marginal cost grows relative to PT minus 4, you ought to see it in prices as well, okay? So the first, 2 points I want to emphasize. First of all, there's co-movement between marginal cost and inflation. But second, and important, there is the big surge in marginal cost before the pandemic inflation. And in fact, if you take into account the difference in scales, marginal cost goes up by about 50% over these years, over these couple of years, and inflation goes up about 35 to 40. So actually a bigger change in marginal cost. Now, where's the surge in marginal cost coming from? Okay, so here we decompose. Marginal cost was total variable cost deflated by output, okay? And all of the action you can see is coming from total variable cost, which was the numerator in the measure of our average cost. On the right is output. In the beginning, you see a surge in output. I think this is the demand for goods, but notice quickly that, at least in Belgium, that drops off. Now, where is the surge in total variable cost coming? It's coming from intermediates, okay? Intermediates are almost totally determining the surge in total variable cost, which is determining the surge in marginal cost. Where are the intermediate costs coming from? About 80% is foreign inputs, okay? And so think about what the shocks are that determined the cost of these foreign imported goods. That's really what's determining marginal cost and inflation in Belgium. And I'm not going to use the term supply or demand right now, but I imagine that both factors were at work. What about labor? Not too much action, but it's something to be looked into. As was pointed out to me, in Belgium, wages are indexed to actually see an increase in labor costs, though labor costs tend to drop off at the end, okay? I think something to do in the future is a more specific investigation of the role of intermediates costs versus labor costs in the recent inflation. All right, so, okay. All right, so now let's do a simulation of the model. So basically what we do is we're going to start in 1999, Q1. That's where the data begins. Then we assume this process for marginal cost, which is random walk with drift. Then we have the actual data in marginal cost, and when they don't line up with that process, that's a shock to marginal cost, which we feed in, okay? All right, so what do we get? The dashed red line is the data. The black line is menu costs, and the dashed blue line is Calvo, okay? And if you look pre-pandemic, the Calvo model and the menu cost model look pretty close, okay? A little bit of difference during the Great Recession period, because there were big shocks then. And so the model kind of gives you too much inflation. The menu cost model gives you too much inflation in 2008, but hits it in 2010. But that's other than that, the Calvo model and the menu cost model are pretty close. The menu cost model, for the most part, gets the surge. It lags by a quarter, okay, but pretty much gets it, I would say. Interestingly, the Calvo model gets some of it, but not all of it, and also a lag. And this is this fact that the menu cost model gives you this surge and collapse, whereas with Calvo, it's slower and there's more persistence, okay? So what this says, another thing this says, okay, that you're explaining about 60% of the inflation with just Calvo, and the rest is coming with menu costs, okay? And if you don't take into account menu costs, there is a potential for kind of misallocation of costs to different factors, okay? All right, this is year-over-year data, so you might complain, look, this is smooth data, it's easier to explain. This is what we get with quarterly data, and I would say it's not bad. Again, the black line is the menu cost model, and the dash blue line is Calvo. Of course, with quarterly data, we're not going to get all of the blips, okay? But I would say it's not bad. Finally, the frequency of adjustment. Here, I would say the model does okay. All right, if you look pre-pandemic, not too badly, except there's this downward drift in the frequency of price adjustment, which suggests that the steady state may be changing. And one of the next things we need to do is adjust the model to take into account this trend in the frequency of price adjustment. The other thing that's going down is the model measure of the frequency of price adjustment. The frequency collapses quickly, whereas it takes a bit longer to go down in the data. And we think one thing that's going on here is we made this heroic assumption of random walk with drift for menu cost. And you would think in the middle of the crisis, firms might rethink what's going on, and they might actually see the drop in marginal cost coming, and we don't really have that in the model, okay? But that's something to do. But we're able to get enough of the movement in the frequency so that the menu cost model does a better job or does a pretty good job of capturing inflation. Okay, so final thoughts. For normal low inflation times, it looks like cost price dynamics are linear, so Calvo's okay. For the inflation surge, it looks like the cost price dynamic, at least based on manufacturing data from Belgium, it looks like the cost price dynamics are nonlinear, and that's consistent with state dependency. In either case, marginal cost does a good job of accounting for the variation in inflation. So what's the next thing to do? Well, it's to complete the model, to model cost dynamics in both normal and abnormal times. And let me be more concrete, since I'm speaking to a Fed audience. This involves improving the model of marginal cost in DSG models. As I said earlier, the marginal cost-based Phillips curve is not esoteric. It's right in most of your models, okay? But what's the problem? The problem is that labor is the only variable input. So the measure of marginal cost is basically the larger, is the labor share, which I learned the hard way in my work with Jordy Galley, that this is not a very good measure of marginal cost. So I think what you need to do is enrich the supply side, and I think this involves allowing for intermediate inputs, energy, and supply chains. So if the pre-pandemic period was when we enriched the demand side, I think now is the time to enrich the supply side. And that's it.
And we have time for questions.
Paul.
So, didn't talk about expectations anywhere in this. I'm wondering, is that following in the part where you have your kind of target price versus the optimal price? It kind of then you'd get a little bit of that deviation in getting things that also care about expectations. Anyways, somewhere there's expectations in the background and how you.
Yes, I think where I was motivated, and I haven't looked at the most recent data, but at least for U.S. data, it seems like long-term expectations are reasonably anchored. That is.
A little bit long-term. This is kind of the next year.
Okay. Yeah. Okay. So, but point one is, I didn't think, at least right now, maybe in the future things will change, that you can explain inflation with de-anchoring. That doesn't seem to be the case. As far as model expectations, we assume rational expectations here. If you could improve by introducing some kind of behavioral expectations, we're not religious about that. That's fine with us.
But was it coming into this difference between the target and like?
Oh, I mean, well, we are making
easy model. Kind of, it wasn't even there, and I'm guessing when you went to the full model, you kind of have.
No, the heroic assumption we make, which I think isn't too bad, is that our optimal reset price is equal to the target price, which is the myopic price. And I guess if you want to, I hadn't thought of it that way, but that would be a reasonable way to think about it. So what you're suggesting is like more general than what we have. We just say firms are myopic, so they choose the static optimum as the optimal price, and we're fine with that interpretation. It turns out in this model, there's not quantitatively much difference between the rational optimal price and the target price, but I think that's a perfectly fine interpretation. Yeah.
Anton Nakov, ECB. So I think one question I have is what is the role of the Kimball aggregator? And if you did do the extension with supply chains, maybe you can get rid of that because that would kind of play a similar role.
Okay.
And if I may, another question.
Yeah, let me answer that first and we'll get to you. Okay, here, the role of the Kimball aggregator is to cause a nuisance. The reason we kept it is in our earlier work where we estimated Phillips curves pre-20, it actually shows up, or at least the data is consistent with a significant desire of firms to keep their price close to their competitors. Now, it's funny, with menu costs, I don't know if I have the pictures of this, the strategic complementarity from Kimball doesn't do as much. And why not? Okay, the Kimball complementarity says you want to keep your price close to your firms or close to the price index elsewhere in the economy. With menu costs, you get a bigger kick in the price level because more firms are adjusting. Well, then there's a kind of multiplier effect. So if there's a kick for all other firms adjusting their prices more, that's going to feed back and get you to adjust your price more. So what we found with menu costs and large shocks, the complementarities really didn't add that much.
Thank you.
Okay.
And my second question is, your model has an implication also for the distribution of price changes. And
yep.
I was wondering if you could compare that to the actual distribution of price changes and how well they
good question.
match up.
Let me get to the data. Okay, a standard thing to do is calibrate the model to the kurtosis, to both the variance of price changes with what we did and the kurtosis. Okay, let me see if I can find the... Now, because we have cost data, we have other things we can use as targets. We're able to use, for example, we can measure directly the free adjustment probability because of the cost data. So we used the standard deviation as a target, but we didn't use the kurtosis. And the kurtosis is somewhat controversial because it's so noisy. I'm going the wrong way. Let me get to this. Yeah, there's something, okay. We undershoot the kurtosis by about a third, okay, the spread. And what's going on here? Well, here's one possibility. Alvarez and Lippi argue that because of unobserved heterogeneity, the kurtosis is not properly measured. When they make a correction, they reduce it by a third. So if we can take their correction and say it will reduce this kurtosis by a third, then we'll be roughly on target. Okay, but let me say, in terms, the thing I think we feel more confident about is there are these studies that actually measure the menu costs as a fraction of revenues, and actually our implied menu cost is pretty close to this. So we feel comfortable. Yep.
Yeah, Sylvain Duc, San Francisco Fed. I wonder, to what extent you think you can apply this framework to U.S. data and you'd find similar results. There's a paper by Montag and Viller that uses BLS data, microdata, and to look at the frequency of price adjustment and kind of the average size. And they find that both have risen, but when they do counterfactual, they basically find that you can account for all the inflation data just with the average size of price adjustments.
Okay.
Kind of suggesting that maybe a Calvo setup is maybe good enough for the pandemic as well. So
possibly. I mean, we'd have to get the micro data and see for ourselves. You know, another possibility is, where did you see the big surges? You saw them in goods data. So maybe it's relative to goods data, but not services. We'll have to see.
Then thanks a lot.
Thank you.
So we are, the program is done for the day. We will have a reception and dinner in this building in half an hour.